2010s. But then there was this one year, 2019-20, when growth slumped to 4%, or even a lower level if we look at the second advanced estimate of that year. So I wanted to understand, using a very basic accounting exercise, the nature of this slowdown. And I also wanted to understand better the narratives that I was reading elsewhere, which were being described as India has lost out on growth, India's growth model is failing, something has broken structurally, and one such narrative even claimed that India has lost a full decade of growth. So very humbly, I'm presenting it as an accounting exercise, as I said. But having done the accounting, I also ventured into looking at the correlates of the slowdown. And it was hard to do fancy econometrics, but I'll present the results for what they are worth. There was one important element that I won't be able to touch upon, and Dr. Subramanian actually pointed it out to me when he read the paper, which is to look at the lagged effects of the past policy choices or events. Given that it's a contemporaneous, simple accounting framework, I did not have the space or the tools to do justice to it. But Dr. Subramanian very generously also pointed out to various chapters across 2 economic surveys in which these lagged impacts have been established. So what exactly are we looking at here when we look at India's last 30 years of growth experience? We see a slow but steady acceleration of growth rates. So if we look at the decadal averages, these averages have inched up. Besides an increase in these average growth rates, another remarkable feature is that these growth rates have become more stable over time. So the dispersion around the average has declined over time, as can be seen in this chart. What is also interesting here is that when we look at this last decade of the 2010s, not only is the growth rate averaging at 7% and has become steadier, in no year except for 2019-20 do we see the growth rate falling 1 standard deviation below the mean. So this counter narratives of it being a multi-year slowdown is something I do not see in the data. I do this exercise in an alternative way, which is to look at the quarterly growth rates. And we look at quarterly average and quarterly dispersion around the mean. Again, there is a very distinct and very sharp slowdown in 2019-20, but except for the last quarter in 2018-19, when growth actually slid below 1 standard deviation of these quarterly averages, again, we see growth movements which may be characterized as very, very generic around the mean. And these look more like the usual business cycle developments rather than a steady structural decline in growth rate. So again, looking into the quarterly data, all we see is a 5-quarter long slowdown, not multi-year structural slowdown. Again, looking at it a little bit more systematically, when we look at these quarterly growth rates, and just a simple regression with dummies for different quarters to capture any quarterly movement in growth rates, and a dummy for each fiscal year at a time, which is the second last row from the bottom, we see a significant negative coefficient for 2019-20. The only other place where we have a negative and significant coefficient is the very first year of this sample period. So yes, growth did slow down in this particular year by about 3 percentage points, which is a very, very large decline. So where was this decline in growth rates concentrated? And this is where that accounting exercise that I mentioned comes into the play. So we look at both gross value added, GVA, and gross domestic product, GDP, and we look at different components of these 2 variables. And here again, we are repeating the exercise at a sectoral level, where we have the average growth rate of the prior years, growth rate during 2019-20, and 1 standard deviation band around those. And now, interestingly, we see actually a very distinct sectoral concentration in this slowdown. Agriculture sector has done well throughout the year. And if anything, the average growth rate turned out to be better than that in the previous years. Services sector does see a mild slowdown, but nothing to write home about. It's the industry sector which nearly collapsed during the year. So it's not just deceleration, it's contraction within the industry sector. And, we kept digging further into the different components of the industry sector to understand what exactly was happening. And we see a sharp contraction in manufacturing sector. But other components of industry also slowed down, including construction, mining, etc. But it's really primarily the manufacturing sector where these slowdown and contraction concentrated. And so what is the magnitude of this deceleration across sectors that we are seeing? So as I mentioned, agriculture and allied activities actually grew faster, and if anything, contributed a slightly larger amount to GDP growth during the year 2019-20. Services sector, a very small deceleration and a very small decline in contribution to growth. It's the industrial sector, which contributed 1.9 percentage point to GDP growth in the prior years, and in 2019-20 took away 0.4 percentage point from growth. So it's an entire turnaround of 2.3 percentage point of GDP. And as I mentioned, largely concentrated in the manufacturing sector. We do a similar exercise for the expenditure side components of GDP growth. And here we do see some deceleration in consumption, not a very large one. Some of it is concentrated in the last quarter of the year. That's when the COVID had hit the Indian economy along with the rest of the world. Not much happening in investment, which contributed 1.7 percentage point to GDP growth compared to 1.9 in previous years. Government expenditure contributed more than in the past. And here on the expenditure side, where we see the most action is in the exports of goods and services, and primarily exports of goods, not even services. The turnaround here is that instead of a contribution of 1 percentage point to GDP growth, we are seeing a decline of 0.7 percentage point of GDP from growth. So 1.7 percentage point of the turnaround. So what could be the potential explanations? The paper didn't start with any hypothesis, and therefore it just looked all around. We use the usual growth models, in which you can correlate growth to various factors. My training is a macroeconomist, etc. Experiences from around the world of the correlates of when growth slowed down or decline to the extent that we see. So there are a few factors that could be potentially behind such a slowdown. Macroeconomic instability. We are seeing what's happening in Sri Lanka today, for example, or there are many, many examples from East Asian countries, from Latin America, where macroeconomic excesses eventually result in cooling of the economies. And these are mostly captured through high inflation, high real exchange rate appreciation, high fiscal deficit, large current account deficits, etc. And these are the kind of variables we look at to see whether we see an anomaly in any of them or a number of them during 2019-20, which could explain the kind of slowdown we are seeing. Slowdown can also happen in emerging markets because of the external shocks. And we are seeing external shocks happening currently through an oil price increase, impact on exchange rates. There could be geopolitical issues, again, the kind we are seeing through the Russian invasion of Ukraine. These can get manifested in the reversals of capital flows from emerging markets. We look at all of these variables as well. Then there could be domestic shocks. There could be economic policy shocks. There could be political instability. There could be any kind of policy shocks. So what we did was we looked at many different variables, nearly 30 of them, falling into each one of these categories. We also looked at the policy narratives that were coming out during the year. So just made some kind of a timeline of the economic policy announcements and political events. It was hard to see what broke in the Indian economy during that year to warrant such a large slowdown. So here is an example of what we saw. So this is CPI inflation, consumer price index inflation, the headline inflation, which is tracked by the monetary policy. And we are just taking an average before and after, or before and during really, though there is a clear downward trend. So inflation averaged 6% in the prior years when growth had averaged 7%. In 2019-20, it was less than 5%. So no macroeconomic excess or instability. Current account deficit as percentage of GDP was in a very comfortable range of less than 1% of GDP as compared to 2% in the previous years. And here we can see what had happened around 2013 when India was battered by the tapering event. India's current account deficit had exceeded 5% of GDP. Nothing of that sort we see during the year. These are fiscal deficit numbers. Combined fiscal deficit is about 7% of GDP. Center zone deficit is 4.7%, a slight increase from the previous years, which I'm describing both to the denominator, which grew at a very low rate, as well as counter-cyclical support to the economy. Financial markets actually were surprisingly steady. Government bond yields are declining during this year, both for the center as well as the states. We don't see anything, again, noteworthy in the equity markets. They are increasing at the pace that we see in the previous years, both in terms of log index and average percentage changes. Capital accounts are absolutely calm. So this is not the event where capital markets react to any country-specific shocks or growth prospects declining. If we leave out this last quarter or last month of the fiscal year, actually both FDI and portfolio flows were rather stable. No oil price shock here, and the volatility index, VIX, is stable as well. Again, we have to ignore the spike which happened during March 2020. Nominal exchange rate depreciated at a steady rate. That's the left-hand side panel, and increase there is a depreciation. On the right-hand side, we have real effective exchange rate, and increase is appreciation for real effective exchange rate. India's real effective exchange rate has appreciated at a steady pace. But during 2019-20, the pace of appreciation was comparable to what we have seen in the past, or in fact, less than what we have seen in the past. So that was about the macroeconomic environment, which seemed very stable and certainly not harmful to growth. Then this is the timeline that I talked about. It's a smaller snapshot of that. And here, I'm choosing to summarize information related to monetary policy, political events, and a little bit about the fiscal policy. So during this year, out of the 6 monetary policy committee meetings that were held, policy rate was reduced in 4 of the 6 meetings by altogether a cumulative amount of 110 basis points. So monetary policy was supportive of growth during this year. General elections were held. Elections were also held for a number of states, and election results were stable, and governments were formed right away. If anything, there are some reform-oriented announcements during the year, the main one being a reduction in the corporate tax rates. And I was, as a part of this narrative, to build this narrative, I was searching the newspapers, and one article in the Mint describes it as the mother of all direct tax reforms. So this is what we see, right? So no alarming patterns in the macroeconomic variables, nothing alarming on the policy front. One thing that happened was, as I said, in the last month of the year, when COVID had hit, many countries, and India had preemptively announced a lockdown. And the first announcement was implemented on March 22. So in the last 9 days of the fiscal year. So as a part of this search, we narrowed down to 3 factors which potentially can explain this deceleration. One is exports, and I'll show some data and evidence on that. Second is the credit growth by banking and non-banking finance institutions. Third is quantifying the impact of COVID during the last month of the fiscal year. So what we see actually is that global growth during 2019-20 was much slower than in the previous years. Particularly slow was the global trade volume of goods and services, and particularly that of goods. So here we are looking at the average growth rate, annual growth rate of exports of goods from the world, of services, and the corresponding averages for India. So during the first decade of this century, export of goods from the world grew at about 10%. Goods exports from India grew at a faster pace of about nearly 15% a year. In the last decade, the growth rate of world goods market has declined to nearly 0. And during 2019, it was actually negative. Growth rate also slowed down from India. It grew only at about 2 percentage points a year, and again was negative, a larger negative from India. And similarly, we see slowdowns in the exports of services, both globally and from India. So here is a little decomposition to understand the decline in exports of goods from India and whether it can be attributed to change in world exports or change in India's share in world exports. And here, interestingly, in this year that I'm focused on, 2019-20, actually a larger part of decline is accounted for by a decline in India's share in world exports. So there is an element of decline because world exports themselves are shrinking during the year, but then India lost market share in this shrinking market. So this is comparing growth rate of exports from India in years prior to 2019 and during 2019-20. So here I'm being a little bit selective with the countries that I've included. I mean, these are the countries which I thought would have done better than India, and that's why they're here. So there are a number of countries which have actually, somebody may need to mute, which actually have had their exports grow at a faster pace than the world exports, which means that not every country was experiencing the slowdown in their exports. India was not one of them. And in fact, during 2019-20, a number of countries still continued to grow their exports, but India's decline, contraction was much sharper than many of these countries. And I will not take much time on this because I want to move on to the financial sector, banks and NBFCs. But we just carried this exercise a little bit more to see whether there was a concentration on specific goods or markets where the slowdown occurred. But it was quite a bit of it was a very broad-based slowdown to all the major destinations of India, oil and non-oil exports. And we also did it by specific commodities, and slowdown actually permeated to many, many commodities. So that was the first part. There was something happening in the global market. The growth of exports nearly has been declining for nearly a decade, and it contracted during 2019-20. India did worse than an average country, and it lost market share. Now, I don't go into the reasons for this. I just speculate that perhaps it has to do with the exchange rate. I didn't have the time or necessarily the space to look at the role of exchange rates. This is something I want to work on carefully in my subsequent work, and I'll be happy to take questions on what I have in mind in order to look at the role of exchange rates. So the second part where we see some anomaly is the financial sector. When I say financial sector, I have in mind banks and NBFCs. So, we have been reading about, and economic surveys have covered it brilliantly on how the Indian banking sector has been down with issues related to NPLs, problems related to excessive lending growth right after the global financial crisis, and how it has been impacting its role and its contribution to economic growth till date. So here, despite the fact that bank lending rate has slowed down in the last many years, 6-7 years, during 2019-20, it slowed down even further. So during 2019-20, growth moderated to 6.5% from 8.5% in the previous years. Interestingly, it's the private sector's credit growth which declined quite sharply. Public sector banks have been growing very slowly last many years, and they continue to grow at that rate, anemic growth of 4.5%. But the major deceleration this time around came from the private sector. A near credit collapse actually from the NBFC segment, both housing finance companies and non-housing finance companies. And this is where we spent some time building again a timeline of what happened, and also trying to look at the sectoral allocation of credit and whether there's anything more we can say about it. So this is the timeline during the year, and it's all in the paper. A number of NBFCs actually had major issues which got played out both in the press. Policy actions had to be taken, the boards had to be suspended, and major restructuring happened. So in terms of the negative news, the first set of news did not show anything that was alarming. But when it comes to the NBFC sector, there is negative news after negative news. So there are issues related to IL&FS, which are just getting resolved. Divan Housing Finance Corporation, there are issues to DHIL, PMC, etc., etc. So it's just a subset of what we collected. And in fact, when we look at the sectoral deployment of credit by the NBFC segment during 2019-20, we see negative growth in many sectors and growth lower than in the past in the remaining sectors. So now the question is, was this decline in credit due to demand or due to supply? We make an argument in the paper that it was due to supply side issues. And the way we justify this argument is that all sectors experienced credit slowdown, even the ones which were growing fast. So first part of the paper shows that not all sectors experienced a significant deceleration, but credit slowed down to even the sectors which were growing relatively rapidly. A second argument is that less demand of credit would have resulted in a decline in interest rate or low interest rate margin, but we do not see it happen. Third is that actually when we started looking at other sources of financing for the firms, and we comb through many different possibilities, we see an increase in supply of credit through non-bank and non-NBFC channels, which means that there was demand for credit. It's just that banks and NBFCs were not able to meet the demand. So this is these are the charts where we make this last argument, and it will get reflected more comprehensively in ongoing work that Professor Arvind Panagaria and I are doing on India's banking sector and NBFC sector. So bank credit as percentage of GDP, this ratio declined to less than 3% in 2019-20, relative to about 5.5% of GDP in the prior years. And remember, these are the years when credit was lower than in previous years. NBFC segment picked up this slack for a bit, but credit growth declined. Credit as percentage of decline, as percentage of GDP declined to 0.8% of GDP, half of what was experienced in the prior years. As compared to that, many other sources of financing, and here we pull together the data on equity financing, loans, private placement of loans, external commercial borrowings, and private equity. All of these together as percentage of GDP have averaged at 6% in the previous years, and this ratio increased to 7.3%. But even this increase was not sufficient to make up for the decline that happened in banks and NBFC. So cumulatively, this ratio of total credit from all these other segments, banks and NBFCs, declined from about 13% to 11%. So lack of credit seems to be behind what we see on the real side data. Another interesting fact, of course, it comes directly from the data that I showed, that these other sources of funding are displacing banks and NBFCs. Banks and NBFCs provided about 41% of the total demand for funds, and this ratio declined to about a quarter in 2019-20. And my sense is that this pattern continues. Now, just looking at other countries, comparing India with other countries, just as we compared India's export performance, and it's the similar set of countries that we have. Average credit to GDP ratio in the world is 85%. In India, this ratio was only 50% in 2013-18. And even though this ratio increased as compared to that average, in 2019-20 for the world, for an average country in the world, it remained the same for India. So this is the anomalous part of financing in India. I will just take a couple more minutes and I will finish within 35 minutes that was allocated to me. I was hoping to finish in less than 35. I may not be able to. We try to quantify the role of exports and finance in the manufacturing sector slowdown. And so we use this, difference in difference kind of estimates. We are trying to find out here, dividing industries into those which are less dependent on external finance, those which are more dependent on external finance, industries which export less, industries which export more. And as can be seen from this table, that the growth turnaround is much larger in industries which depend more on external finance and industries which have traditionally been exporting more. So this is just some quick quantification. COVID. Now, COVID is interesting, right? I mean, we can be dismissive about it, that during the fiscal year, it was prevalent or it impacted economic activity only in the last 8 or 9 days. But when we look at the monthly data, there is a very, very sharp decline in all kinds of indicators during that week or during that month. So here is an attempt to quantify the impact of COVID on growth. And the underlined are the calculations. So if you think about it, 52 weeks in a year, about 2 percentage points of economic activity gets generated in any typical week. And also remember that when slowdown extended into the subsequent year and quarter, in the first quarter of 2021, growth contracted by 24%. So we assume that growth would have contracted by a similar amount in the last week of March 2020, when the economy was under a very, very strict lockdown, the strictest of all, actually. Slowly the activity was relaxed. So just using these two numbers, we estimate a growth contraction, contribution of growth contraction of 48 basis points to annualized GDP growth. Looks too large to believe, but you can do these calculations later. It's just 2 percentage points of GDP, which contracted by 24% during that year, during that week. So just to conclude, India's growth has steadily accelerated, has become stabilized over the past 3 decades. 2019-20 seemed like an aberration when we look at what really got broke during that year to warrant a large slowdown of about 300 basis points. It was hard to account for it by shocks or policy actions during the year, but 3 factors seem to stand out: a sharp contraction in global trade when India lost market share, the NBFC crisis, but also the fact that the banking sector was still not ready to lend to support growth, and COVID during the last month of the year. But even so, macroeconomic stability and policy frameworks were maintained all through. The paper did not look at the lagged impact of policy frameworks and policy choices in the previous years. But thanks to Subbu, I read very rich evidence on this in the economic surveys of 2019-20 and 2020-21. Thank you very much.
Now the discussant, Professor Subramanian.
Thank you very much, Arvind, for inviting me to discuss this very important paper. I'll just quickly summarize and then give you a sense of where the paper could actually make further headway to really nail this issue. I think no doubt this is a very important policy issue, important policy paper, something that as the CA I had actually had to explain. So it's really nice to see this paper. In one sense, if I actually look at the key takeaway from the paper, I actually am glad to see something that I kept saying all through, in my media statements, that the decline is not structural, that it is part of business cycle. And that's basically, so this paper comes along and actually, vindicates that stance, based on the judgment and based on the data that we had seen at that time. So bottom line, the paper basically says that the 2019-20 was an outlier compared to previous years of growth of 7%. Structural, not structural, but part of business cycle. And the decline is attributed to primarily manufacturing. I interpret this as due to credit problems, and I'll actually I'll have more to say on this. The fact that, as Poonam, very nicely showed, that industries that depended on external finance contracted far more. And therefore the credit crisis basically did lean possibly toward a significant impact on manufacturing. I think what is important here actually, and this is one direction where I'll sort of push Poonam further, is manufacturing by far is actually far more dependent on external finance than services or agriculture, and therefore this is something, just linking it further to the financial sector, I think will really help in understanding far more comprehensively this slowdown. The second part that Poonam and co-author actually talk about is exports, and the data clearly shows in theirs that the exports decline started, the precipitous decline started in 2017-18. Interestingly, the elasticity they find for Indian exports to world exports is greater than 1, and I think that is clearly seen in this table that I put here as well. If you look at the 2001 to 2011 versus 2013 to 19, and this data is there in the paper, I've just summarized it, for your benefit. The decline in exports growth rate basically from 9.9 to 1.5 for the world, but for India it is a decline from 15% to 3.6%. So clearly this illustrates elasticity being much greater than 1, and that's one key contributor. The COVID, which actually, the third contributor that Poonam talks about, in my opinion, actually, and I'm mentioning this comment right away because I'm not going to belabor this further, that I think that the actual impact, would have been greater than the 50-odd basis points that they are attributing, because it's important to see that, the impact was not restricted only to the last week. We were, for instance, tracking a lot of high frequency indicators at that time. If you look at the Google mobility indicators, the Google mobility indicators in the entire month of March were down about 20% compared to Jan and Feb levels for India. And March being such an important last month of the financial year, I think, just estimating for that 1 week, extrapolating from the 24% decline, I think underestimates the impact. I also, and consistent with what I'm saying here, is the precipitous decline in consumption in the fourth quarter. compared to the first 3 quarters, that is absolutely consistent with the precautionary savings motive. So this was not restricted only to the last week. If it was the decline in consumption was only in the last week, that kind of decline in consumption could not have happened. So I think that is clearly indicative that the month of March is something that actually should be looked at. So my sense is that the impact will actually be greater than what she has estimated by just using that 1 week. And I think correlating with some of the Google mobility indicators, etc., might actually give her greater, traction on this particular angle. I think, as I mentioned upfront, the diagnosis at that time actually, and which is what led to the policy response, the reforms response. If you look at the entire reforms that have happened, during COVID, they've been focused primarily on manufacturing sector growth and exports. If you take the PLI scheme or even the factor market reforms, they've been focused on manufacturing. So I think it is very nice to read a paper which is basically very consistent with the analysis and judgment that that one had made at that time, that the decline was not structural, was primarily because of manufacturing and exports. So also this has important implications, because the way Poonam motivated the paper is to understand what growth would be going forward, given that the diagnosis was that this decline was because of manufacturing and exports, and therefore the policy response has been clearly tailored towards manufacturing and exports. I think that bodes well for for basically looking at future growth, something that again, maybe in this paper or other work, Poonam and co-authors can actually look at. So I'm going to focus on my comments actually, and this is just a chart showing how the exports is taken from her paper only. The decline in exports started in 2017-18. From the quarterly data, it's clearly visible there. My comments are going to be primarily on the lagged effects. These are comments I shared with Poonam about a week back when I read the paper, and I think I have some specific suggestions on what can be done in this direction. But because this is such an important point, not only for this paper itself, but also for a lot of debate that happens around growth in India, I think I want to spend some time actually talking about this. So this chart is drawn from the 2019-20 economic survey, which correlates basically the fixed investment as a percentage of GDP with GDP growth. And what you see is, while contemporaneously it is negative, and that is expected because investment actually requires a cash outflow, but when you correlate it with 3-year and 4-year lags, what you see is that the 4-year lag is actually by far the strongest and positive. Even 3-year actually is positive. What this means, therefore, is, and actually, it may be useful to do a similar exercise for reforms, some reform index, tracking it with growth as well, that the impact of actually, investment or policy is felt with a lag. And I think, when we explain to our students, we talk
Emily, we lost the voice.
Looks like there's a connection problem.
AC in a
Did
room.
we lose you?
Only...
Yeah, good.
Hello? Are you able to hear me?
So go ahead. I think now you're back.
Yeah. So let me just state this, because this is important, that the whether it is investment or policy itself, the impact is felt after a lag. And I think, checking into a room of a hotel actually is best indicator of that. So when we look at the impact on growth rate, it is important to consider these lagged effects, and something that this paper also must do. But there is a much larger, importance of lagged effects. And actually, I had observed this particular, articles that were written between Dr. Panagaria and Chidambaram. And I think I particularly like the statement that in this article in Times of India that Dr. Panagaria made, saying how much growth took place during the tenure of a prime minister and how much growth he delivered. The two important differences being took place versus delivered. Took place, I think, is basically many other factors, while delivered actually has a causal, angle to it, are two distinct questions. And I think that is something inter alia one must include lagged effects as well. And particularly for those, media folks who may actually be checking this video or maybe here, I think it is important that actually, the innocent comparisons that are made in the media taking, oh, I look at basically the 10-year period of X government versus Y government, I think they are indeed innocent. A more careful comparison must be one that at the very least looks at lagged effects and global economic conditions. And I think it's time that Indian economy actually moves away from these kind of innocent assessments to far more careful assessments. That's a broader point actually to be made in the context of lagged effects. But in the context of the paper itself, I think the relevance of financial sector problems is really important. And I would suggest that Poonam and co-author particularly look at this section, a full analysis that we had done in the 2019-20 economic survey state of economy chapter. The section was titled "The Recent Growth Deceleration, Drag of the Financial Sector on the Real Sector," because it highlights the role of financial sector problems in the slowdown. I'll also have comments to make on fiscal policy and possibly what might be the contributions, which maybe Poonam and co-authors should definitely try to take care of. So on the financial sector problems, and I think there's a large literature, Atif Mia and Ahmed Sufi write on this. In the interest of time, I'm not going to go into the details, but for completeness, I've put the sequence of events as well. But I think across now several chapters, in the 2019-20 and 2020-21 survey, I think it is in the economic survey, it's amply clear that crony lending and financial sector mess was the worst legacy of the 2004 to 2014 era. Why? Because this literature clearly shows that when a crisis originates in the financial sector, the overhang on the real economy is really prolonged. In contrast, when the crisis originates in the real sector, problems are not as prolonged. And I think if anecdotally as well, if you compare the global financial crisis versus the COVID crisis, the way growth has come back, I think it's consistent with this literature as well. So this is really important to look at in terms of the impact on growth. And if you basically, just to cite the paper, Mia and Sufi, they say a sudden credit expansion, and this is mentioned in the economic survey as well, which is purely supply-led, results in short-lived expansion of output and employment, but causes significant contraction in the long run. The IMF study in 2017 does the same thing, finds the same thing for 80 countries. This is what India went through as well. And I think it is time that not only academics, but even policymakers and other stakeholders recognize this rather than trying to put out narratives that basically do not fit the data. And I'm going to quote here from the economic survey. This is para 143 clearly, which summarizes this point, that the Indian economy since 2011-12 had been under the influence of slowing cycle of growth. The fixed income investment rate has started declining sharply since 2011 and 12, and subsequently plateaued from 2016-17 onwards. Given the lagged impact of investment rate on GDP growth that I showed just now, with the effect being most pronounced after 4 years, the deceleration in growth since 2017-18 is consistent with the framework, the virtuous cycle framework that basically was described in the 2018-19 survey and was used to assess the slowdown itself. Just quickly, a couple of important points. If you look at this particular chart, which shows the proportion of corporate loans in Indian non-food credit, you see the peak in 2013. And that is clearly, note the inflection point in 2013. I'm going to also refer to a table which basically where we showed the correlations between credit expansion and corporate investment. What you see clearly in this table, this is table 9 in that particular chapter, that it is only the correlation between credit expansion from 2008 to 12 and its impact actually, or correlation with investment from 2013 to 17, only that is significant and negative. None of the others are significant, which tells you that it is the expansion from 2008 to 12 by those corporates that basically excessively borrowed. They were the ones that cut down investment significantly. And this is something that will be very useful for Poonam to actually look at, especially because manufacturing sector is far more bank loan dependent. Even export credit, and that may also be something that they can look at, because while there was clearly slowdown in the world economy, it's possible that export credit actually, or the lack of it, could have exacerbated these problems. So the specific suggestions I have here is that the way we basically examined this for the overall macroeconomy, maybe doing a similar analysis, but just focused on credit given to manufacturing firms, showing the boom bust there, and then showing the impact of the boom bust on credit to manufacturing firms on their investment, and finally then tracing that impact of investment by manufacturing firms on manufacturing sector growth would actually be very, very useful, especially given what they are finding very clearly and consistent with my own intuition at that time as well, that manufacturing sector growth was really impacted. A similar exercise for export credit also might be useful as well, though I feel that the impact of export credit may be much lower than that for manufacturing. That's just my gut feel based on having seen the economy over these years. Now, next, I actually want to talk about fiscal policy, and this is a very subtle point and that I want to make, and I think it's extremely important. Oftentimes we basically do not, look at the impact of this, and this is where experts actually, need to really sort of look at. I think this is well established that overall counter-cyclical fiscal policy is extremely important, because when there is a crisis like there was, because of the dual balance sheet problem, there is decline in investment. At the same time, risk aversion increases in the private sector, and pessimistic expectations set in as well. And government spending then basically not only works as a spending multiplier, but even risk multiplier and expectations multiplier. And that is why I think the counter-cyclical fiscal policy is very important. I'm referring to the chapter 2 in the 2020-21 economic survey here. But I think what is critical, and I want to highlight this especially. So what is being done in this chart is actually, this is adapted from the second chapter. Here we're showing the private sector, net balance and the government net balance. If fiscal policy is counter-cyclical, you should see a correlation close to -1 here. You do this for the US or you do this for the UK, and these charts are all there in the in that chapter. You get a correlation close to -0.95, -0.99. And yet when you see for India, starting from 2011 itself, some part of it was policy paralysis, but later as well, you see that there has been actually not counter-cyclical, actually pro-cyclical fiscal policy. And I want you to note here that starting from 2016, which is when the banking sector cleanup started, private sector surplus started declining. And this is the time where fiscal policy should have been counter-cyclical, and that is where and economists like us actually needed to have identified this at that time, actually to basically have counter-cyclical fiscal policy. But fiscal policy has been pro-cyclical since 2011. Only since 2019, and Poonam pointed out correctly that government expenditure has increased. You will see from 2019 onwards, fiscal policy has been specifically counter-cyclical. It up until 2018, it was not so. And I think there is basically an important role that this played as well, because the banking sector cleanup that happened reduced the private sector surplus from 2016 onwards. And there was definitely a need for counter-cyclical fiscal policy, because what pro-cyclical fiscal policy does is to exacerbate those business cycles. And I think this is something that, the impact of this must also be looked at to find a more comprehensive assessment of the slowdown itself, because of the lagged effects that are there. And I think here, while Poonam and others may contend that actually maybe there was no need for for fiscal policy to change, my contention, and I think that this is driven by the reading of the business cycle literature and the fiscal policy literature itself, is that fiscal policy cannot just be based on the current macro indicators. Fiscal policy has to be based on assessing where we are in the business cycle. And I think, as Poonam has clearly showed, that these were supply side related, which clearly meant that there was actually a problem in the private sector, a crying need for counter-cyclical fiscal policy, which I think, was not done, has started happening since 2019 onwards. And these are some charts actually just to show why this is important. If you look at, and these are just final few slides. If you look at in the Indian context, this is very important. If you look at the time series correlations for the US, UK, etc., by just looking at the time series correlations, you cannot disentangle causality in terms of, does growth lead to debt sustainability, or debt sustainability leads to growth? In the Indian context, though, it is very clear, and this is there in the economic survey itself, that it is growth that actually leads to debt sustainability, not the other way around. And that is primarily also, for instance, if you look at for the US, that is not the case. You can see here that, either which way you do growth versus change in debt, or change in debt versus growth, the correlations look identical, unlike that in the Indian case, for instance. Now, this is important because it is the R minus G differential, and this is based on Olivier Blanchard's AEA presidential address, that it is in the Indian context, the R minus G differential has a very strong correlation with with basically the change in the public debt, and that is why this is the most important to look at. And I think that that R minus G differential itself, change comes primarily from growth, not from the interest rate. So growth is extremely critical for debt sustainability in the Indian context, and therefore counter-cyclicality of fiscal policy is extremely important in the Indian context. And I think this is something which may be useful for for Poonam to actually look at, by possibly looking at differences across states in the adherence to fiscal rules, to see if she can try and actually estimate the impact of fiscal policy. Because what is important here is to generate the counterfactual, that if fiscal policy had been counterfactual, what would have been the impact, and that may be something to look at. Finally, and this is something very quite important from the, I think, fiscal rules for India need to be thought ab initio based on where India is as an economy. Cannot be a cut paste of EU's rule. The Maastricht Treaty is a political document, and if you look at the 3% fiscal deficit, 66% debt to GDP ratio, that is basically a cut paste from EU, from the Maastricht Treaty. It's a political document. Ignores important differences, whether it is in terms of infrastructure requirements that India has versus the European Union, the importance of infrastructure as as a public good, and therefore the FISC to invest, and the fact that India's growth potential is very different from the EU. And so, it affects the R minus G differential and thereby debt sustainability. And I think this is something that has to be recognized. Cut pasting from advanced economies, I think, is something we can do better than that for sure. Also, there are conceptual problems with debt to GDP. I'm not going to get into this, but I think this is available for Poonam to actually take a look at. Finally, because this is from a forward-looking perspective, and that's how Poonam motivated the paper, I think it is very important, that academic research is done on understanding hysteresis in the Indian context. I think, I see a lot of, loose comments being made on hysteresis, especially in my interactions with international agencies, where they just take basically the way hysteresis is thought about for advanced economies, where all the firms are formal was and cut pasting it to the Indian setting. I think this is something which has to be actually thought about more carefully, because informal sector firms are far more labor intensive, and unlike in the case of formal sector firms, for whom a shock to earnings can basically mean that debt obligations become difficult to pay, they have to sell assets to take care of the debt obligations. That leads to a decline in productive capacity, and that is at the root of economic hysteresis from a crisis. This happens for formal sector firms, not necessarily for informal sector firms. In fact, informal sector actually, and that is a trade-off, that because they're actually more labor intensive, their earnings come back immediately when economic activity resumes, and the constraints on their obligations are soft because they're not from the formal sector. So informal sector actually ends up cushioning in bad times, but acts as a drag in good times. That's a trade-off that the informal sector presents. Therefore, I think hysteresis, and there should be good work in this, academic work, looking at hysteresis in a country like India. I think that, and this is something that Poonam spoke about as well, the corporate tax rate cut, even though this was certainly not done anticipating COVID, and there's no way one could have anticipated it, but I think the corporate tax rate cut might have really helped in creating earnings buffers in the formal sector firms, and thereby avoiding hysteresis in the formal sector. So net, when you do a forward projection of growth, the fact that informal sector firms do not suffer as much hysteresis, and the cushion that was provided by the corporate tax rate cut and other policy meant that formal sector didn't suffer as much hysteresis, is really critical when we assess growth going forward, apart from the various reforms that have been done. So in sum, I think this paper actually is a very important paper, clearly shows that the decline was not structural, it was just part of business cycle. I think doing more work along the directions and other directions based on Q&A can really help in basically providing a more comprehensive picture on this. I think on manufacturing, exports, and COVID itself can actually there could be more work done. I think the key policy lesson that I would take away from here is basically never mess with the banking sector or the financial sector, because the overhang from that on the real economy is extremely large. And I think the short-term benefits that you may get actually are just not worth messing with the banking sector. So I'll stop here, and thank you very much for once again providing me the opportunity.
Thank you very much. That was a very interesting paper, followed by a very comprehensive and interesting discussion. So we have about 10 minutes for Q&A, and I'll kick off the Q&A session with a question of my own. So Poonam showed that, exports were declining. Exports were quite responsible for the slowdown that we saw. But the poor export performance, India's poor export performance has been a problem for quite a few years. Export performance before 2019, 2020 was also not, nothing to write home about. So coming out of this, even if it's business cycle related, coming out of this slowdown in growth, and maintaining an 8% growth in the future, which is essential for India to even move from being a low middle income country to an upper middle income country, it would be really important. And so Poonam said that this was kind of beyond the scope of the paper and the presentation to explore why exports were not doing well, because exports are endogenous to the whole, the economic situation in the country, as well as, and she provided one answer saying that it had something to do with the real exchange rate. Even that is endogenous. So I'm thinking of, trade policy is, could trade policy be responsible? Can other kinds of labor regulations, land regulations be responsible? If they are, for the poor export performance over the last number of years, then this is not a short-term problem, and it has to be kind of dealt with, and we cannot dismiss this as a business cycle issue and something not structural, right? So this would be my first question to both the presenter and the discussant. But I'd like to collect a few more questions before I let you answer, because we don't have a lot of time. So I will start with a couple of questions that I already have. So from NR Superna, we have this question. If you say it is the overhang of previous crony lending, what is the crony lending post 2014? And the second question is from Rahul Jain. What have been the structural or foundational improvements in the Indian economy in the last 10 years? So we have about, 8 minutes to wrap up this session. So, one of you can go ahead, either Professor Subramanian or Poonam can go ahead and answer these questions that we have now. And, time permitting, we may have a few more questions. If we don't have the time, we won't have any more questions.
So Devashish, if it's okay, I'll go ahead first, and I won't take much time, and I'll leave the rest of the time for Dr. Subramanian. So I'll address the first and the third question to the extent I can. So what should be done for exports to grow much more? I'm mindful of the fact that I'm sitting at Columbia conference and among economists trained at Columbia. So I'm looking up to you and Praveen and Professor Panagaria to tell us what needs to be done. But from my perspective, in the last decade, when global world exports had slowed down and India did worse than an average country, exports still contributed. I'm talking about gross exports, not net of imports, contributed 1 percentage point to GDP growth. It was during the 2019-20 that that contribution became negative, and there's a very sharp turnaround. Now, in terms of what can be done, and you mentioned a whole host of factors, and I agree with all of them. I would also like to remind that the performance differs when we talk about exports of goods versus exports of services, to which I've started to add export of labor. So we have done relatively well when it comes to exports of services and exports of labor, which means that remittances that we receive, I think close to about 3% of GDP every year. So exports of goods or production of goods is intensive in the use of labor, logistics, finance, and regulatory environment. And I absolutely agree with you, it's a hard task. So a lot of things have to change for us to be able to do much better in exports. For actually a representation to some of the parliamentarians recently, I even looked at the state level exports of various merchandise items. And, we are not a very well diversified export basket to begin with. And so we need to diversify both in terms of what we export and who we export to. And among the factors that you cited, and I'm just, just collaborating those, are the trade agreements that the country has now started getting into. But again, you all know the answer better than I do. I would say that let's broaden this discussion to exports of goods, services, and labor. Somebody asked, what has the country done in terms of improving the potential growth in the last 10 years? In another paper that I had presented at some of the forums, India Policy Forum, etc., we look at last 40 years of growth performance, and we look at the correlates of growth. And in fact, despite all the noise that we hear about things not going well, on most of the correlates of growth, whether it's the quality of labor, quantum or quality of capital, except for the last few years, regulatory environment, business environment, states being able to devise pro-growth momentum, there has been a lot of progress on all of these correlates. And therefore, we see the kind of acceleration we see in growth. We are a very interesting country that we are growing at 7% and we are aspiring to grow at a much higher rate. But let's keep in mind the last decade's performance has been 7%, much higher than that of the previous decades, which means that despite all the noise that we all enter into and contribute to, correlates of growth and contributors of growth have been improving all around. I'll stop there.
We have 3 minutes left, and Professor Subramaniam can, give his thoughts on these questions.
Yeah, firstly, I think, Devashish, I want to clarify. You mentioned about structural. I think the session itself and Poonam's paper is looking at whether the slowdown was structural. What you're talking about actually from the export side, I think that's a structural problem that is not particular to this particular growth episode itself. That has been a problem that has been there for the last 30 years. I think that important distinction is something that you have to keep in mind. Now, let me, there was a question about the crony lending. Let me clarify what I actually, and maybe because I had to rush through, I did not go through in detail. The evidence, and I would urge you, if you're interested, to go and read this particular section in the State of the Economy chapter in the 2019-20 Economic Survey, and that may help clarify the diagnosis, based on very carefully constructed evidence, is that it is crony lending up until 2014. In other words, firms that actually were the ones that got these crony loans, they were the ones that eventually, reduced their investment significantly. I showed you that table, maybe I had to rush through, and that is what then the decline in investment eventually led to the decline in growth. So I don't think I did not say that crony lending after 2014 has accounted for this particular phenomenon. I think as the entire literature has shown, that the impact of crony lending is very long drawn. And why? I think there is a sort of a sequence of boxes I showed. It starts with when you give out a loan, typically recognition of bad assets itself takes time. Banks many times do evergreening, zombie lending. Only when the loan becomes due, which is typically after 5 or 6 years, because corporate loans are of that maturity, And when, evergreening and zombie lending are discovered by the regulator as well, that is when the recognition of the non-performing assets and the fact that we have a problem in the financial sector happens. And so typically, and in the Indian context as well, that happened actually around 2015 or so, even though, there were reports that pointed out this problem before. So it is crony lending up until 2014, not once after, that actually led to the decline in investment, corporate investment, the dual balance sheet problem, and that in turn had an impact on the growth. So I hope this clarifies very, very clearly. Last part, I think I'm just going to, because there were questions on manufacturing, what is the reforms, etc. I'm just quickly going to show a presentation so this was, the state of the economy presentation that I'd done after the second quarter GDP numbers had come this year. I'm just going to quickly, show that presentation because it's quite important from the perspective of. So if you see this is basically the India's manufacturing sector GVA growth. If you look at the period from 2015 to 19, India versus China, and if you look at it, basically, you see that clearly India has done better in the 2015 to 19 period, whether it is growth in manufacturing GVA, merchandise exports, manufactured goods exports, or even sectoral patterns as well. So clearly, some things are actually starting to show up on manufacturing. But why is it that what is the reason? And this actually also I've done, in detail, and I'm not going to go into that here, but I'll just quickly point out strengthening of physical infrastructure. There's a lot more to be done, but some good, signs are emerging here. Significant improvement in logistics efficiency, in terms of average distance covered by trucks per day, and sort of the national highways, number of lanes. The turnaround times in major ports has declined significantly. And of course, I think the competitive tax rates have helped in this process. So there is some good signs, but I think, as the impact of the many reforms focused on manufacturing growth and exports will start manifesting, these phenomena should start accelerating. I'll stop there. Thank you.
Thank you very much for an excellent presentation and an excellent discussion that followed. And we'll have to end the session here. Thank you very much.
Thank you.
Thank you, Devashish. You really kept to the time. Fantastic. Both great paper and great discussion. I have lots of questions for both of you, but I will ask those to you separately when we have a bit more time. So we will right away move to our next session. I want to just say, I see Merit has joined us. So Merit, thank you. Good to see you. NK is here also. NK, great to see you. Well, our star of the next session is here, Mr. Uday Kotak. Good evening, Uday.
Hi,
thanks
Arvind.
very much.
Great to be here.
Fantastic. So thanks very much for giving the time. We know economists like to think in terms of opportunity cost, and we know what the opportunity cost of your time is. So truly grateful that you could make time for us. So Uday, I want to divide our conversation into about 3 segments. In the first segment, I want to get some bit of your personal story. So we, from very heavy discussion, we get to a bit of light discussion, learning a bit more about you. In the second segment, I will come to your core kind of activity, which is banking. So I'll have a few questions on banking. And in the third segment, then again, related actually, would be the non-bank finance companies. And I'll have one question on that. So that's the kind of format I'm going to follow. And each of these questions, might take me a minute or two to set up, to give some background and all. So audience has to be a little patient with the questions as well. But you would get equally rich answers. So that patience will be paid off. So we begin with your personal story, Uday. So from your Wikipedia entry, I gather that you grew up in a Gujarati family, and the entry says that this was a joint family in which about 60 members shared a common kitchen. So that's quite unusual. Even, in fact, I precede a little bit your generation. I'm 1952 born, you are born in 1959. Even then, actually, a joint family of 60 members in those days, especially in urban areas, was rather unusual. The Kotak family ran a cotton trading business that also comes from this Wikipedia entry. So, what was it like growing up in such a large family? What role the business of the family in cotton trading played in your early kind of formative years? How did it sort of impact your future trajectory of life? So there's a set of questions with which we begin.
Thank you, Arvind, and delighted to be with the group of people on this wonderful platform. Before I start about my joint family, I just wanted to say my immediate family, three of my family members have a connection with Colombia. My wife studied in Colombia long back in 1982 to 84 at School for International Affairs. My older son, Jai, has studied at Columbia undergrad. And my younger son, Dhaval, right now is doing his MBA at Columbia. Therefore, the joint family for me is expanding to include the Columbia fraternity as well. And therefore, this
Lovely.
is a very special moment for me to be on this platform.
I should say that we also have at Columbia a Kotak lecture, which happens every year. And Jagdish Bhagwati generally organizes that. It's also a part of the Raj Center activity.
Right. Yes. So for me, the joint family expands to the broader Columbia fraternity as well. That's the purpose of sort of giving that background. And I just wanted to say that, one of the most interesting aspects about the Indian system is the joint family system. And my learnings in my early days was effectively, if I had to summarize, was a joint family system is, especially if it happens to be in business, is capitalism at work, socialism at home. Therefore, inevitably what happens in a joint family system is at the workplace, you're out there competing in the market as a business. But moment you come within the family setup, it is a certain set of rules which are socialistic. All my cousins and I were set off to the same school, irrespective of any choices. There was a standard formula for how we were treated at home. I was a set of 8 or 10 kids which were treated similarly. So you actually began to imbibe the values of living together, being able to adapt and adopt to a whole host of uncles, aunts, cousins, different perspective, different temperaments. And it's really, really served me in a great way as we built Kotak. I think about the Kotak team and Kotak business team overall like a joint family in terms of how we interact with each other. And that's one of the reasons why, if you looked at our senior leadership at Kotak, the average tenure of this team is more than 20 years each. So it really comes from a culture of what I call as middle class values, high aspiration, but learning the art of being able to adapt and adjust to the sensitivities of each other. It's a huge learning. And I think satellite families, and I see that even in my own kids, it's a very different culture of how they go about things compared to how we were brought up. And I think there's a value system which comes along with a joint family, single kitchen. And can you imagine so many people staying together, one kitchen, different needs, but it worked. And I'm very proud of that. And I think the joint family system is at the root of what I call as core HR at Kotak.
Very good. Is there ever a reunion these days?
Yeah, we meet family members. We meet at Diwali, all of us. All of us get together. Yeah, and it's great fun and different ages. Of course, I have now moved into, as a kid, as a joint family, I was the kid of the house, and you would then go and meet the elders, and on important occasions, they will give you a little special prize of a 10 rupee note or 11 rupee note. Now I'm supposed to be a little more on the elder side, therefore not the eldest side, but I'm somewhere in the middle to senior now in the hierarchy. Of course, we all stay separately, and now the world has changed, but
of course,
the joys of the family still continue to reverberate in my mind.
Fantastic. Okay, so we move forward. You did bachelor's in commerce from Sydenham College in Bombay, and then an MBA from Jamnalal Bajaj Institute of Management Studies. That was in 1982. Yeah. And then you went on to launch your original startup, and apparently with less than about 30 lakh rupees or 3 million rupees, of which 25 lakh or 2.5 million rupees came from your own money, some family money, and some friends. And then you had about 5 lakh, about 500,000 rupees invested by Anand Mahindra. And so I take it that that's where the Kotak Mahindra joint venture kind of name came to the startup eventually. And he had just returned from the Harvard Business School at the time, I understand. Now today, from then on, you are India's #1 banker, founder, MD, and CEO, what is probably the most profitable bank in India. Kotak Mahindra Bank has a market cap of about close to $50 billion. It's probably a significant part of the banking industry in India. And at just 63 years of age, you are personally the 5th richest Indian. So how did all this come about? And in particular, somewhere between 1982 and today, did you have a realization early on, kind of, in the earlier part of that period, that it was going to really become this big, that something really big was afoot? And if so, when about?
It's Arvind, I'll just give a 30-second outliner of before 1982. As I said, we were in a joint family. So my father and my grandfather, I was very keen on coming to the US for studies. Okay. And my grandfather put his foot down, saying that if this boy goes to America, he will not come back to India. He will find a career and a future there. Therefore, we must find a way of seeing that, we will lose our son, this typical joint family mindset in those days. And therefore, we got to find a way of making it attractive for him to build a career in India. So I was a pretty protected child, I can tell you that. And then I did my MBA from Bajaj and actually wanted to join a company called Hindustan Lever. And that's where my father stepped in and said that, son, if you want to start, and I was always very fascinated with finance. So he said, son, if you want to start a finance business, the family will give you 200 square feet of office space in prime Mumbai district of Flora Fountain. And do what you want, but start something on your own. And I took up my father's bait and actually started this company. And we didn't have much money. My family, the joint family business was also going through challenging times at that stage. So I borrowed money from some family and friends. Some of the friends put in capital and started doing business. Sorry. So my first client actually was a company called Nelco, which is where Mr. Ratan Tata started his career. And I started a business of bill discounting, where I would basically buy and sell commercial paper and make a spread. The second client was Mr. Anand Mahindra's company. He had just come back from Harvard Business School and had joined his father's steel company, Mahindra Eugene Steel Company. And I started doing business. I said, we will produce financing for you in 24 hours. And this is physical world days. And it used to take weeks for companies to get financing from banks. So he started doing business. And then I invited Anand to come and take capital in the company. I invited Anand's father to be the chairman, first chairman of our company. And the real logic was, I am a believer that businesses are built around brand and reputation. And in my subsequent visits, one of the most important aspects, including what I read, was if you look at Wall Street and the US, some of the biggest names in the world are Goldman Sachs, JP Morgan, Morgan Stanley, Merrill Lynch. These are all family names started by individuals, which have become institutions beyond individuals. Therefore, the real dream was to put our family name and reputation on the line and build a financial institution which hopefully would sustain and survive over a long period of time. And that's why the name was Kotak Mahindra. It started as a finance company. We then went into a joint venture. And again, on joint ventures, my logic was simple. India was a little bit like in the well kind of mindset in the 90s. We needed to have much fresher approach to life. Therefore, went ahead and did partnerships with Goldman Sachs in the investment banking and securities business. It was Goldman's first joint venture anywhere in the world. And I can assure you, I had to do a lot of hustle, including a few trips to New York to convince them that I was a worthy partner for building their business in India. I still remember a wonderful incident where after we started getting to know each other better, there was a meeting in Hong Kong where the then partner of Goldman said, Uday, can you fly down to meet? I've got a couple of senior partners from Goldman. This is 93. And the two senior partners from Goldman who visited Hong Kong and we had dinner together were John Corzine and Hank Paulson. And we had a wonderful dinner meeting. At the end of the dinner meeting, the two of them did some side talk with their Hong Kong partner called Mark Evans. And they said, can we hire this guy? And Mark told them that this fellow wants to build a business in India. He would love to partner you in India, but he's not going to join Goldman as a partner. Therefore, that's how the concept of a joint venture with Goldman started. We then partnered with Ford Credit thereafter because Anand Mahindra had got into a joint venture with Ford. So the financing arm, we did a joint venture. And then Arvind in 2003, under Dr. Jalan's Reserve Bank of India, they opened up for a banking license. And like being the adventurers we were, we decided to apply for it, got through the front door. My friends at Goldman and other places in 2003 said, oh, this is a low ROE, lousy business called banking. My view was it's customer sticky. That's why we got into it. Irony of the situation is in 2008, Goldman Sachs became a bank. And I have a great relationship with them. In 2005-06, we bought back the stake of our joint ventures from both the partners. Our relationship continues to be good. And what started for us as a 3-member company, and it is a journey of middle-class values, fun, joy, a family system. And as I stand in front of and discuss with all of you, we are now a small little company with more than 80,000 employees.
Fantastic. Fantastic. It's quite a story, actually. It's interesting that, in that generation, as we were growing up, generally the parents wanted their children to go abroad because that was the ticket to a good living for the rest of their life. Whereas, quite the contrary, your family did exactly the opposite, and they obviously knew what they were doing. Okay, so we move to second segment of my set of questions. We come to really now talking about Indian banking. What I want to do, set up this is with some context. So there is a contrast here between banking on the one hand and two other sectors, telecommunications and civil aviation. In 1991, about 10% of the assets in banking sector were in the so-called old private banks, and the rest were all in public sector, 90%. Civil aviation and telecommunications, on the other hand, were completely in the public sector monopolies. But as a part of post-1990s reforms, private sector was given entry in both telecommunication and civil aviation. And also the door to private entry in banking was opened much wider. So in effect, you would say that there is equalization across the three sectors where public sector operates, but private sector also opens up. Now, in both civil aviation and telecommunications, private players very quickly expanded to dwarf the public sector entities. And with privatization of Air India, of course, civil aviation is now almost entirely in the private sector. There are some small kind of public sector operations still left, but those are really tiny. Same is true of telecommunications. BSNL is a very tiny part now of the overall telecommunications market. But the process has been much slower in banking. After 30 plus years of reforms, more than 60% of the assets of the banks still remain in the public sector. Why is it? How do we explain this kind of relatively slow transition from the public to private in banking?
Arvind, I think if you go back to the 90s, the 90-10 split, which you talked about, within the 10%, there was total private sector. And within the 10%, there was also the foreign banks. So actually, take out the foreign banks, the number of private sector banking share was about 6 to 7%. And if you recollect, Citibank and other banks also were growing pretty fast in those days in India with their relatively modern approach to innovation and all that. So from a 6 to 7%, I would say private sector in India really caught the wings post the opening up for new private sector banks in 1994. And thereafter, subsequently, when we got the banking entry in 2003. Keep in mind 2 or 3 points. One, on a marginal basis, now more than 50% of the incremental growth is going into private sector banks, more than 50%. Today, the split is give or take 60-40 between public sector and private sector. Public sector now is around 60%, private sector banks are 40%. But another very important point is, public trust and distribution, the scale and the branch network which public sector banks had was much wider and deeper in the country. So one reason is the sheer distribution reach which public sector banks had in the terms of branch distribution and other things. The second is, over all these years, post-bank nationalization in 1969, the amount of money the government and the state has thrown into public sector banking for very poor returns is another important point why they kept on keeping some of their share. Therefore, if you had a player which continued to produce very low ROE, but kept on giving away goodies to customers at non-economic rates of return on capital, and in many cases, negative returns on capital, you will have an industry which will continue to have reasonable market share. So we have to keep the context of a business where effectively private sector was dependent on private capital, needed to produce ROE, and public sector did not have similar accountability in it. And of course, there were significant burdens of social sector lending, which came along with being a bank, whether public or private sector. So relatively lower expectations or acceptability of much lower returns on capital, which happened in the favor of public sector banks. Wide niche distribution and network were some of the important factors while they continue to have the stake. But on a marginal basis now, private sector is growing at a much faster clip in terms of market share in the last few years.
Okay. So I want to come to now, this issue of privatization of banks, of the public sector banks, which is seems to be on the table now. But I want to get your thoughts on it, and let me just point out, at least in my thinking, what the background to this is. That if you look at almost any indicator of performance, almost on every single indicator of performance, the private sector banks beat the public sector banks by a good margin. One simple indicator, or maybe two I will mention. One is, if I take just the capital, the valuation of two of the private banks, Kotak Mahindra and HDFC. Together, they are probably twice twice of all the public sector banks. It could be more than twice actually, but about between you and HDFC, you're about more than $150 billion of valuation. State Bank of India, which is the largest bank, public sector bank by far, its valuation is maybe about $55 billion, and the others are smaller. So together, I'm pretty sure that they all are well below $150 billion, which is the valuation of the two of you. Also, if you look at the NPAs, just the sheer scale on which recapitalization has had to be done in the last almost, we've been doing it almost continuously since late 1990s. But even the recent recapitalizations have run into something like 20, 25 billion, maybe $30 billion worth. Very large investment or infusion of taxpayer money that has gone into this, and it ultimately still has not really translated, certainly in the equivalent market valuation, because market valuation still, recapitalization itself probably is very large in relation to the market cap of these public sector banks. So one is really driven to this conclusion that, isn't there ultimately a huge cost that the taxpayer is paying here? And so I certainly have therefore very much leaned heavily, and I write this publicly, that perhaps it is time to privatize, if not all, at least most of the, maybe leave the State Bank of India in the public sector if there is compelling reason for some sort of social objectives, but the rest of them be privatized. So I'm going to get your sense of, there are alternative models. There is Nayak Committee report, which kind of suggested a roadmap for reforming them within the public sector. So that's another possible model. There may be a third one and all. But want to get your thoughts on that.
I think, Arvind, the government of India itself has announced a policy where they are going to keep basically 4 or 5 public sector banks, and the rest, the intent is to privatize. I would like to believe in the year 22-23, they will move a bill to allow privatization of public sector banks. And I am quite hopeful and confident we'll see a few banks get privatized in the fiscal year beginning from April 1. And that's a good beginning. The question which comes, and which is a more fundamental question, is the future of a bank itself with the technology onslaught which is happening, and therefore the underlying value which the traditional banking model will have in the context of the changing times. Therefore, I do believe this public sector banks, there will be demand, there will be buyers for it, but the concept of banking itself is undergoing a cathartic change. And many of us, we keep awake and probably don't sleep at night thinking about whether we'll have a bank tomorrow morning, because how fast are we changing our business models? How fast and capable are we on the technology platforms, the changing customer preferences? How are we going to keep ahead of our times? And to give an analogy from the 1890s and the 19th century, late 19th century, we are moving to a world from the world of horses, the world of the automobile or the car. I mean, you go back to Henry Ford in 1915 when horses got replaced by cars. So we're going through one such transformative change in the arena of financial services. And it's extremely important for us to be aware of that change. Therefore, when I look at our future, I don't think about our future our arena any longer as just banks, whether it's public or private. I look at my arena as the consumer tech, financial services, the broader consumer and customer layers, where we will be competing on a completely different level. And therefore, in that context, while the government is now moving, which is a good thing, the lay of the land has changed. And that is going to have its implications on ultimate valuations of traditional banks. The world of cars has come in, and it's probably got 100 years later, it's the world of electric cars. So that's the change we are in.
Okay, well, then let me ask you then a related question, which has also been in the discussion and debate in India. This has to do with the banking licenses to the corporate sectors, non-financial corporations. This has been a big issue in India. There was a working group of the Reserve Bank of India which made the recommendation that this is something that ought to be considered. And now that, when you mention the role of technology, evidently, you would think that when there is a lot of synergy between banking and technology, and therefore at least the technology companies perhaps be brought into the banking sector in a kind of more central way. And this is also in the context that of my earlier question, that the transition from public to private in banking has been slower, and perhaps not enough. It's not because the Reserve Bank of India is hesitant to give banking licenses, but it's simply that there are not enough takers of the licenses that have come through, and a lot of the capital that could actually come into banking probably is with the non-finance corporations. So there is that issue as to whether there are two views on this. Obviously, a set of people argue against it because they fear that this will lead to a lot of crony lending by the banks to their own corporations. Anything you can say to elucidate on that?
Arvind, again, I'll go into the fundamentals of the case, trying to think about the case from an objective point of view. Finally, whenever you're looking at banking, you got to, in that context, and in the context of your question, really 2 points come in: availability of capital, and second is conflicts of interest. On availability of capital, the world in India has changed compared to what it was even 10 years ago. Thanks to global capital flowing and domestic capital, pools of capital getting bigger through insurance, pension funds, asset management players, private equity, access to pools of capital for entrepreneurs and business people in India has got much easier. Therefore, the capital is no longer the scarce domain of a few large business houses. The biggest test of that will be actually when state-owned banks get sold. And if capital flows in other than from large houses, it will prove for convincingly that access to capital has got broader. So that is point number one. Point number two, if you look at some of the challenges India has faced in the financial sector in the last few years, forget history. It has all been about connected lending, indirect movements of money across different groups, and scandals. And the last thing India needs at this stage from a governance point of view is allegations of crony capitalism. And there is a risk to that, because if one of the things which you're seeing is, especially in the last few years, disproportionate growth of few large business groups compared to the rest. And a lot of the other groups have actually become much smaller. So we have to ask the question, what is the business model India would want? Free-flowing, open capital markets with access to capital for businesses which produce returns, or significant concentration with risks of conflicts of interest in few hands?
Okay, all right. So let me come to the last question this week. Here we get to the third segment, which is out of banking into non-bank finance companies. Now here in 2018, the NBFC sector went into a serious crisis, and IL&FS, infrastructure leasing and financial services, which is the largest kind of NBFC in India, was at the forefront of this crisis. The government at that point turned to you and, in an unusual move, appointed a banker to head the non-executive chairman of the special IL&FS board constituted to steer the NBFC out of the crisis. Now, the issue of NPAs in the banks, we understand that. That's an easy one to understand. I think the understanding of the NBFC crisis is not quite as good. And so you can just walk through us in this last question and in this last segment and explain, and how you have been putting it back on its feet.
Arvind, in some ways, this is connected to some of your earlier questions as well. So 2018, September was a seminal moment for the Indian financial sector. By Indian standards, one of the larger non-bank financial institutions called IL&FS, Infrastructure Leasing and Financial Services, was going belly up. It was a AAA rated company and started defaulting in September 2018 in the markets, in the debt markets, and had a debt of about $14 billion. Not very large by global standards, but by Indian standards, it was perceived to be India's Lehman Brothers moment. And the government of India stepped in and took steps to appoint a new public interest board, which I had the responsibility to be the non-executive chair. And what we found to as we went through that whole experience was 347 companies below the umbrella of IL&FS, which was regulated by the Reserve Bank of India. And it was in every single sphere of business, starting from finance to townships to roads to education to technology, what have you. And effectively, it created a systemic issue, a AAA rated company, and 6 layers of governance: the management, the board, top quality institutional shareholders who were shareholders, which included global and domestic institutions, auditors, world-class auditors, rating agencies, and of course, regulators. And all the 6 layers of checks and balances actually, in this particular case, failed. And it was a company which was in existence for more than 25 years. So as I speak with you, the systemic crisis has been averted. We have been working at it for 3 years. We have now, we have given an estimate, and we have completed about a very significant part of the recovery. Creditors and stakeholders will get more than 60% of their monies back in a country where bankruptcy resolution process is producing less than 30% or around 30% in terms of creditor monies. So we have been able to make fair amount of progress. The systemic crisis has been averted, and it shows that when the government moved at the right time and at speed to avert this, at the same time did not do the moral hazard of putting money as equity into this company. So at this stage, I think the financial system in India is back on its feet and completely sound. IL&FS crisis gets the creditors about 60% of their money. And Arvind, just for your information, I complete my 3+ years in this, and I hand over charge to a team as of April 2 to a gentleman who you probably know, Mr. C.S. Rajan, ex-Chief Secretary, Government of Rajasthan, who will then take it from here as I complete my term. But the crisis is averted, the system is safe, and creditors will get more than 60% of their money.
Well, on that note, congratulations. I think that at one time, actually, it looked very, very fragile. So government made the right choice, putting you in charge of the of averting the crisis. So thanks very much, Uday. This has been a great conversation. Please keep sending more of younger Kotak children to Columbia. All the brilliant people. We would love to have more of them. And thanks again for joining.
Thank you very much. We are trying to convince our kids to expand their families too.
Good. Okay, thanks.
Thank you. Goodbye.
Okay. Bye-bye. Thanks, Uday. Thank you.
Thank you.
Yeah. All right, Karthik.
Wonderful. So I guess we're jumping. Can you hear me there?
Yes, we can.
Perfect.
So Karthik, I'll just quickly introduce you. So, Professor Karthik Muralidharan is a professor at University of California, San Diego, and he's very well known both in the United States and in India. So I don't need to give a longer introduction. And over to you, Karthik.
Wonderful. Thank you so much, Arvind. It's such a pleasure to see so many familiar faces, even though it's only remote. It feels like yesterday that I was there in person 3 years ago, when we did the conference, when I met many of you in person. So I'm delighted that we have this session on health and health insurance. I'm also delighted that we have the speakers we do. So just, as chair introducing the topic, for 1 minute, we talk a lot about growth rates and poverty reduction rates. And most of the public discourse on this ends up happening at the aggregate level when we look at what's happening to the rate of poverty. But if you look at the microeconomic data in terms of who gets poor, what you'll see is that there's an enormous amount of movement in and out of poverty, in and out, in and out. So it's not like, there is an average where everybody is going up. There are people coming out of poverty, people falling back, right? And so this is a very dynamic, stochastic process, which we don't understand well enough because we don't really have that many or any really good panel data sets except maybe IHDS. And the reason I mention that is when you go look at the dynamics of household poverty, it turns out that the single biggest source of what takes a household that's above the poverty line and takes them back below poverty is having a health shock in the household, right? So the health shock hits you in multiple ways. It means that often a primary breadwinner, somebody is no longer productive. It means you're diverting a lot of assets and resources off the household to the care of that person. And often even after kind of distressed sale of your assets, trying to take care of the healthcare expenses, the person may not recover, and then you're stuck in this kind of going back in the cycle of poverty. So this is, for those who study poverty at the micro level, this is one of the most important sources of vulnerability for the poor. And in fact, Anirudh Krishna, who used to be a Rajasthan cadre IAS officer, who's a professor of political science, has an entire book called One Illness Away, right? So the whole title of that book in terms of studying poverty dynamics is the role of illness. So naturally, what that suggests is that the individual and aggregate welfare consequences of having effective health insurance are going to be quite high. And that's going to be the topic of our session, and I'm delighted to introduce the paper presenter, Professor Anup Malani of the University of Chicago, who's done a lot of work on health insurance in India with a range of co-authors, who's also been working on different aspects of COVID and is really quite, well versed with all of the intricacies of the Indian healthcare system. I'm also delighted to have as discussant Radhika Jain, who's just finished her PhD in global health from Harvard, completing a postdoc at Stanford, and is one of the leading young researchers. And I think she's got some very nice papers again in Rajasthan on health insurance and hospitals' reactions to health insurance. So so I'm just here to steer the ship and over to the prime actors. So take it away, Anup. I think timing wise, Arvind, it's about 30 to 35 minutes, right? And then we have 10 minutes for the discussion.
Yeah.
Anup, over to you.
Yes. Thank you, Karthik. Can everybody see my screen?
Yeah.
Yep.
Thank you for this opportunity to present. This is my first year at the conference, but hopefully not my last after this presentation.
Good.
So I'm going to give you a little bit of background on the healthcare system in India with a focus on financing, and then I'm going to talk about a big experiment we did to figure out potentially the impacts of health insurance, public health insurance in India. And then time permitting, I'll talk a little bit about PMJ, which is the current national scheme providing health insurance in the country. As Karthik said, this is joint work with a large team listed at the bottom of the slide. Projects like this cannot be done by individuals. They require group effort. So a little bit of background on healthcare in India. I think Karthik already hinted at this. There have been a lot of concerns about healthcare in India. Concerned that India spends too little on healthcare, only about 4% of GDP. There's concerns that India has very limited supply. A very notable statistic is about half of children live in villages without healthcare facilities. Work by Neeraj Sood and others suggests a lack of physical infrastructure, 10% fewer hospitals, 50% fewer clinics than one would require based on international standards. As a result, you see two things. One is often many people go without care. So about 25% of untreated ailments are due to financial constraints, according to NSS. And even those that do get care often are left impoverished, as Karthik said, after care. So one important thing to know is about 75% of care at the point of service is paid out of pocket. As a result of this, people suggest that perhaps 63 million people in India are pushed below the poverty line each year due to healthcare expenditures. Now, international comparisons validate this picture. So here I've got India as compared to the BRICS, and also averages for middle income, lower middle income, and lower income countries. And you'll see that India has GDP per capita that's somewhere in the range of the lower to middle income countries, just slightly below, but its percentage of GDP spent, according to the World Bank, it's a lower number than I gave on the previous slide, but their percentage is lower than even low-income countries. It has a higher share that is private expenditure as opposed to public expenditures, and a very high rate that's out of pocket. This is lower than on the previous slide, but again, this is specifically data from the World Bank, so different source, but a higher rate out of pocket relative to even other countries that are lower income. So yeah, on these fronts, perhaps India is a country of higher concern. Now, let me give you a little history of policy in India. I'm going to talk about the public sector and the private sector, but also the evolution of insurance. So if you look at what India historically done, at least on government policy side, it's been really supply side focused. So the government through the 80s is focused on building hospitals, training physicians. To the extent it goes further, it provides disease specific campaigns, basically public health campaigns, often vaccination. You see in the 1990s, though, that the private sector has expanded. There are two reasons typically given for this. One is that a lot of international donors to India are stressing privatization, and so there's this at least accommodation of growth in the private sector. And a second one, which I think is really a driver, is that growth in India is accelerating, demand for healthcare is accelerating, public supply is unable to keep pace. And so today, if you examine it, about 75% of care that's taken up by Indian residents is provided at private facilities. Now, in the 2000s, in the noughts, you see a shift where India's policy shifts away from purely supply side to demand side. And that's despite having efforts to increase both PHCs and CHCs. So let me spend a little bit of time talking about that. Now, the initial drivers of this were at the state level. You have a number of state level schemes like Yashasvini for cooperatives, Vajpayee Arogeshri for tertiary care hospitals, but you also start seeing some early, at least later in the noughts, some central schemes. So you see RSBY, Rashtriya Swasthya Bima Yojana, arise in 2008, first in the Ministry of Labor, and then shifted over to Ministry of Health, and then it succeeded in 2018, 2019 by PMJ for secondary and tertiary care primarily. Okay, but it's important to remember that despite this shift, if you step back and look at the government budget, in addition to just the overall spending, you see that spending on the demand side, paying for care at even private hospitals is what I mean by demand side, that's still a small fraction of overall spending. So the Ayushman Bharat budget is about 6,400 crore in 2021. Compare that to the Ministry of Health budget, which is around 74,000 crore. If you added all sources of public health spending in India, it's an even smaller share of the 180,000 crore. So demand side is still a tiny fraction of total supply side. Okay, but it's growing. Let me dive a little bit more deeply into RSBY and touch briefly on PMJ here. I'll hopefully return to it at the end. So RSBY is a program that runs for about 10 years, and at its peak, it provided insurance to hospital insurance in particular to about 170 million people out of 280 million people that were eligible for the scheme. So who was eligible? Primarily individuals that were below the poverty line, so roughly in the bottom quartile, and certain vulnerable occupational groups. I'm going to examine in this study Karnataka, and so I just gave you a quick sense of what the BPL lines are in that state. What's covered? It's a hospital insurance scheme, and in a particular type of hospital insurance scheme. So you have primary, secondary, and tertiary. Primary is non-hospital admission. Secondary is hospital admission. I typically think between 1 and 4 days, and then tertiary is longer-term treatments that may take more than 4 days or recur over time. This scheme is focused on secondary care and specifically an empaneled hospital. So you see the introduction of network hospitals through this program. The prices are set by the government, and then the government provides premium to pay for private insurance that covers up to 30,000 rupees of expenditures per year per household. Okay, if you're a health economist or a doctor, you might say, well, how much does that actually cover? What is the purchasing power? It's something like 10 MRIs, 2 appendectomies, or 4 C-sections a year. I wouldn't encourage you to do that specific course of treatment. I don't think many doctors would, but it gives you a sense of the resources that this purchases for you. Very important, there are no deductibles and copay. So if you're introduced to health insurance, say in the United States, this is a big surprise. There's no co-insurance to discourage excessive use of care. Seems appropriate for India for 2 reasons. One, India may not have the resources just now, the IT infrastructure, to be able to collect those deductibles and copays and keep track of them. And second, one might be concerned that India has a problem of underspending on healthcare rather than overspending, and so moral hazard isn't your first order problem when you're designing health insurance. Okay, who's covered? Up to 5 members of a household. The premiums that the government pays is about 300 to 500 rupees per year, although Karnataka has fallen over time and at the low end was spending about 150 rupees per year. Of course, that's the premium paid by the government. An individual household would have to pay about 30 rupees for a smart card. So if you want to think of that as a cost of enrollment, that's fine, but it's a small fraction of both the premium and obviously the coverage. The administration is through a smart card. It's like a debit card. It's cashless, so you directly pay the insurance companies. You don't have to put up money. It's run by the states, but largely financed by the central government. Let me talk very briefly about PMJ. So in 2018, I think really the ramp up occurs in 2019, RSBY is replaced by PMJ. It expands eligibility to what is called the vulnerable population in the SECC, and that covers about 537 million lives. Also, enrollment is automatic rather than during an enrollment drive. Again, the cost to the household is about the same, 30 rupees. The coverage, though, is much bigger. You're covering not just secondary care, but tertiary care, and there's some effort to expand primary care provided by the government. The overall cap grows from 30,000 rupees per year per household to 5 lakhs, so much larger, although if you look at much of the expenditures, it still stays below that 30,000 rupees. There are no deductible, no copays, no cap on household size, so that's an expansion. Like RSBY, no pre-existing conditions. Better than RSBY, it's portable. You can take it across state lines, but functionally run the same way, although financed a little bit more by the state governments rather than the central government. Okay, so I want to stress 2 things in that change. What PMJ really did, if you look at the first order effects, is expanded eligibility from 280 million to 500 million, covering a large number of lower income but above poverty line households. And the second thing is it expanded coverage from secondary to tertiary, although again, the bulk of claims are still within the range that would have been covered by RSBY. So we conducted back in 2013 a large-scale randomized controlled trial. We've called it the Indian Health Insurance Experiment, to look at the effect of expanding eligibility. Now, the reason we did that is that if you look at the history of public health insurance schemes across the world, once a country starts, it seems to keep on expanding and ratcheting up on eligibility and then on coverage. And so we expected that would happen in India. It ultimately did prove true, but hopefully this RCT will help us understand what the likely impact of that young expansion is, that is to say what PMJ's eligibility expansion will be. I'm going to focus specifically on 3 policy questions because really what we want to know is how to design and administer a program like PMJ. So what are the 3? The first one is India has a limited budget spent on health care demand, that is to say public health insurance. How can it make it go further? What is the price that it should charge for that insurance? Should it give it for free or charge a premium? Second, why was RSBY's utilization among below poverty line people, at least, it was low? Why was it low? Is it because insurance is a new product? How do people actually learn about insurance? Will PMJ make a difference in utilization of insurance and then separately of care? Third, does health insurance actually improve, or will it improve health in India? The prior literature in low and middle income countries suggests that there's very small effects. There's studies done, RCTs in Mexico, Cambodia, Nicaragua, Kenya, all seem to suggest not very big effects. In India, the evidence is mixed. Jishnu Das and Leno, looking at RSBY very early on in Delhi, find no real big effects. However, Neeraj Sood and co-authors studying Vajpayee irrigation in Karnataka find significant mortality effects. So does Subramaniam, who's on the call. Dr. Subramaniam, he finds significant effects, especially in child mortality in PMJ. Those two studies are not randomized controlled trials, but they're well-done studies. Okay, so let me tell you about our study. As I said, it's a randomized controlled trial. It was done over a number of years, so it's one of the longer studies done looking at the impact of health insurance. It goes from 2013 to 2019. It's done in one state, but we chose where to do it in that state so that we would get some geographic range, and that's greater external validity. So I really like to think of it as having been done in South India, in the Mysore district, and in Central India, Gulbarga district of Karnataka. Okay, so what did we do? In each of these districts, we picked villages. So there are about 424 villages across the two districts. Within these villages, the villages, by the way, were picked to be within 25 kilometers of an impaneled hospital, so as to make sure that people with insurance actually had access to hospitals. Otherwise, insurance wouldn't be that valuable. We enrolled about 11,000 non-BPO households. BPL households, we mean households that didn't have a BPL card, so weren't eligible for RSBY, and didn't otherwise have some sort of hospital insurance. This was a study that's quite large in the context of randomized controlled trials. I think it's arguably the second largest health insurance experiment ever done. It was kept very large because we needed that sort of power to detect about a 25% change in utilization, even accounting for some attrition. We look at a range of outcomes. I'll talk a little bit more about this. Uptake into insurance. We'll look at utilization of insurance and hospitalization, as well as health outcomes. Okay, now here's another important thing. If I want to answer those questions, I have to look at a number of different interventions that help tease out some of the answers to those questions. So what we did is we randomized households to 4 different methods of access to insurance. So the first is some households we gave free RSBY insurance. So these were APL households not eligible for RSBY. Now we made them eligible for RSBY in collaboration with the government. Second is some households we sold insurance to, the RSBY insurance, and we gave them some cash equivalent to the insurance premium, but it was unconditional. They could do whatever they want with the cash. A third group, we just sold the RSBY insurance, but provided no premium subsidy. And then obviously there's a control group where we made no interventions at all. Also importantly here, in prior studies, there was some suggestion that the behavior of neighbors affects your behavior when it comes to healthcare utilization. We wanted to account for these spillover effects and potentially learning. So what we did is we varied the fraction of households in each village that were given each of these different forms of access. That allows us to estimate the effects of these spillovers. But overall, roughly we gave about 40% of the households free insurance and 20% of households were each of the other groups B, C, and D. Okay, I'm not gonna cover this slide. For those of you that are interested, we can go into the details of exactly how the randomization is done. What I wanna do is I wanna focus on the outcomes and then tell you about some of the impacts. Okay, as I said, we study uptake and utilization. I wanna talk very briefly about the health outcomes and then give you the timeline. We look across a range of topics. So self-reported care, chronic disease, quality of life, mental health, childbirth, various objective biomarkers and measures of mortality. And we look at them for females and males at 18 months and then head of household at 3.5 years. Turns out to be a large number of outcomes, and then you multiply that by 2 surveys. So it's we're pretty fairly exhaustive on these. What was the timeline of the study? Just so you get a sense of how this progresses alongside the development of RSBY. The study begins in 2013. We identify eligible households during that year. At the end of that year, we conduct our baseline survey. 18 months later, we do the enrollment. 18 months later, we do our 18-month survey post the enrollment. RSBY actually ends before our study ends. And what we're going to do is we're going to measure end-line outcomes around March 2019, looking at this period before it ends. Okay. Now, one last thing. We estimate 2 types of effects because as it turns out, we provide access to insurance, and you may or may not enroll. We want to look at just the effect of providing that access and providing that access at different prices. Sometimes this is called an intent to treat effect in the literature. And then the second thing we ask is, conditional on enrolling, what is the impact of having insurance? Regardless of how you obtain the insurance, whatever arm that you were in. This is done through instrumental variable estimation, where the randomization to access is your instrument, sometimes called a treatment on treated estimator for those of you interested. Moreover, for each of these two estimated effects, we're going to try to break down effects that are due to the direct effect of giving a given household this treatment, say insurance access. And then the second thing we're going to do is we're going to ask, what is the effect on a given household of giving your neighbors access to insurance? Okay, so let me turn to the results. The first and top line result is that uptake was substantial, but it was affected by price. So let me break this down. I'm going to first quickly describe to you the numbers. So just so you have a benchmark, RSBI enrollment among BPL was around 60% across the nation. Okay, it was 60% in Mysore, it's about 40% to 50% in Gulbarga. In the trial, for an APL population, if you sold insurance, about 60% of the population took it up. If you sold it and gave a cash transfer, about 72% did. And if you gave it for free, about 78% of eligible households took it up. Okay, so what do we learn from this? One thing that we learned is that sale of insurance, among an APL population, actually had greater or generated greater enrollment than even free insurance for the BPL population. You might wonder, is that due to income? And we don't think that's the answer, because even within our population, which varied by income, an increase in income doesn't, and an increase in wealth, by the way, doesn't really affect enrollment. What we think is really going on is marketing. While we use the same marketing materials that RSBY does, the one difference between the way that we enrolled versus RSBY is that when we showed up with an enrollment truck in a particular village, we didn't simply announce it a few days earlier with chits to eligible households. We actually went door to door, and that seems to have dramatically increased enrollment. Now, a second major result is that not all households took up even free insurance. So only 78% did. Some people might wonder, why not everybody? Well, as it turns out, this is a very common result across the world. Even with free insurance programs in the United States, you don't get full enrollment. It's about 62%. Just because something is free doesn't mean it's always going to get full enrollment. There are frictions along the way. There are studies that suggest enrollment frictions are a serious concern. So a recent study, an RCT done in Indonesia, looking at uptake, found uptake frictions. This is Banerjee et al. In 2021. In addition, in India, in prior RCTs that have been tried, there was not uptake, suggesting that there's potentially low demand for insurance amongst the population, just a low willingness to pay to begin with. A third conclusion that you can draw from this is that cash transfers actually increase your purchase of insurance by about 12 percentage points. So that's going from here to here. Now, I don't think that this is entirely due to people's marginal propensity to want to spend extra income on insurance. It's just too large and unbelievable. It cannot be reconciled with the macro data on the degree of out-of-pocket payments. I think what it really reflects is goodwill to the study. So I wouldn't make such a big deal to the providers of the study. So I wouldn't make it such a big deal about it. However, what I would make a very big deal about is the fact that if you go from selling insurance to giving out free insurance, you only increase uptake by 18 percentage points. That suggests that you are paying for 80% of population, actually 78.71% of the population's premiums, just to get an 18% increase in insurance uptake. That suggests a very high cost of effect, or a high effective premium for incremental enrollment. Also suggests the possibility that you can get pretty far, at least among the APL population, by just selling insurance. That would reduce the cost to the public fisc of expanding public health insurance. So now let me talk a little bit about utilization. So we certainly saw that utilization of insurance rose, but we don't see that utilization of care rose. So let me break that down into some discrete conclusions. First, it seems that while you did see that providing free insurance at 18 months increases your utilization, increases it to 13.5%. That's about a 74% increase relative to the control group. At 3.5 years, there's also increase about, sorry for the interruption. So there is an increase in both of these, and these are substantial relative to the control group. And you see something similar with respect to enrollment. But if I were to go break this down, and there's a table in the paper where that's broken down, we find that at 18 months, a lot of these effects are driven by spillovers. That is to say, utilization of insurance rises because other people in the village are getting insurance, not just because you're getting insurance. It's about 50% larger than the direct effect at 18 months when you look at access, and it's about equal size, maybe a little bit smaller than the direct effects at 18 months for enrollment. We don't see much of an effect, indirect effect, or spillover effect at 3.5 years. Now that's a complicated set of statistics, so let me try to translate that for you. I think what this means is that at 18 months, there are a lot of individuals who are learning how to utilize insurance from their neighbors who get insurance. At 3.5 years, you don't really see that effect. People have figured out how insurance works, and so the learning effect is short run. In addition, our analysis of the data suggests that the learning effect is concentrated among the lower wealth, lower income households. Those are the households that seem to be newer to insurance and the ones that need that learning. It is unlikely that these spillover effects are due to supply constraints. That is to say, everybody's going to the hospital and there's not enough beds. And the reason is because we don't actually find very big healthcare effects, healthcare utilization effects. All right. So that's my second interesting result. While use of insurance rose, the use of healthcare did not actually rise. The amount of hospitalizations did not significantly increase. There was a 25% increase at 18 months, but it wasn't significant, and there's no effect, very close to a precise zero at 3.5 years. This suggests a few things. First, what insurance does is shift how you pay for care from being out of pocket to being paid for by insurance. It does not change the amount of care that you get, suggesting that the primary benefit of insurance is financial. And this is also consistent with literature from US studies suggesting that the main benefit of insurance is displacement of payments, not an increase in actual health. Now, there is more utilization increase in the United States, but we still think that the main benefit is financial. Okay. A third result that I think is very important and surprising to us, we found that many people attempted to use RSBY, but were unable to do so. They failed at doing so. And these were large increases. So about 3.3 percentage points increase in access causing attempts at use that failed. Same thing with enrollment, about 4 percentage points. Okay. To give you a sense of context, the rate of failed use is about 50% of the rate of successful use of RSBY. We did a follow-up study to figure out why that was, and we found that there were both supply side and demand side factors that caused this. One is that a lot of hospitals and insurance companies not accept the card, and we heard stories about the IT system not working, although a lot of times it could have been because the hospital didn't actually want to accept the RSBY payment and accept this individual as a patient. There are also demand side issues. A lot of people forgot their cards at home. They didn't know which hospitals used the care, were impaneled, and so on. So I think we would want to address both of these. The last thing I'll say is that utilization fell over time. I don't know if that's a function of RSBY in general and its administration, but we certainly saw this, and it's something to look out for with PMJ. Last thing, before we start thinking about policy implications, we found insignificant health outcomes. This, I think, is a top-line result. So while health insurance utilization increased, health outcomes did not improve. Access or enrollment showed few statistically significant effects across our 82 outcomes. On each of 2 waves, only 3 significant changes in outcome. This is consistent with what other RCTs in other low and middle income countries have found. This could be either because of low increase in healthcare utilization that we found in the study, but it could also be due to the fact that there's plenty of evidence suggesting that the quality of care at healthcare facilities are of low quality. Jishnu Das, Manoj Mohanan have prominent studies on this. Kruk has studies on this in other low income countries. Now, that said, I want to be very cautious about what I say. We cannot rule out that there were some health effects. What I can say is that the health effects were statistically insignificant. If you're interested in knowing what the nominal health effects are, they're about 11% of the standard deviation of healthcare outcomes across all the 82 measures at 18 months and 3.5 years. So there is some nominal effects. But again, I don't want you to overinterpret this, because often those effects can sometimes show up as negative and not positive. Okay. I should acknowledge that this could be that a study even of this magnitude lacks the power to estimate precise effects. People have asserted that and suggest that you need much larger studies, which typically are only possible with administrative data as opposed to randomized controlled trials. But one should also be a little bit cautious about this. There's a statistical debate about whether or not these other studies are finding effects, in part because they too are underpowered for the effects that they find, and the only thing that they possibly could find is very large effects. Smaller effects would not show up, and thus potentially would not be published. Okay, so let's talk about some of the implications for implementing PMJY. So here I'm not going to be talking about PMJY and how it's doing. If there is time, I will talk about it. I think with 5 minutes left, there might be some. What I want to talk about is the implication of this study on RSBY, what are its implications for PMJ. And I think of two. One is, I think it's very important to realize that a lot of households were unable to use insurance. This is not the first time we've seen this. We've seen this in other studies as well, in Indonesia, in Mexico. Well, I should say in Mexico. In Indonesia, people found difficulty in enrolling insurance. There's a number of supply side and demand side reasons, and we can address both of those. This is not the first time, again, people have found that there's demand side issues. Prior work has shown lack of awareness of how RSBY works. Even in Karnataka itself, a work by Rajashekar and colleagues in particular is notable in that regard. But we also know that there's some issues with RSBY's payment infrastructure, and there's some concern that the low reimbursement rates in RSBY discourage hospitals from taking on RSBY patients, which can explain some of the supply side effects. Okay. A second thing that I want to highlight is that there's spillover effects on utilization in RSBY. That has implications for how we market insurance. Sometimes it's better to spread out across villages efforts to get utilization rather than focusing on whole villages at a time. The idea here is that a small amount of utilization villages will cause a spillover onto other households utilizing care. So if we're interested in spiking or increasing utilization, we want to spread our efforts and get just at least a minimal level of utilization in other places. Again, this is something that we've seen in the literature by folks like Chatterjee et al. In 2018. So this is not a new result, but forms a cohesive story. Okay, I have about 3 minutes left, I think, in the 35 minutes that I've been allocated. So I want to talk a little bit about Ayushman Bharat. Professor Subramaniam has also done some good work on this, and so you should also read his book chapter on this. We're going to be looking roughly about the same time, but I'm going to focus a little bit more on the implementation of RSBY, of PMJ, rather than the impact of PMJ as he has. So this is early data on PMJ, so not the most updated to 2022. So a large number of states have signed on to PMJ. In the first 8 months, 33 states had signed up, so that's pretty good. Or 30 states and territories had signed up. There's variation in how insurance was run. Unlike RSBY, where you were providing private insurance, that is to say the government was paying for a private insurance company to provide insurance. In PMJ, there can be two models. You can have either that model, or you can have the model that Vajpayee Arugeshri did, which is where the government serves as the insurance. That's sometimes called a trust model. And so you see a variety of these models being employed. States get a choice. In terms of implementation, as other people have noted, not all states have implemented. West Bengal actually is pulled out of PMJ. It often serves as a control group. There are some states that lagged. I think Rajasthan initially lagged in PMJ enrollment. One nice thing about enrollment in PMJ was auto enrollment, but it's not as broad as we'd hoped for. So you get about 2.6 claims per year in the years it's been in existence. That through January 2021, that's led to expenditures of about 7,400 crore, so still relatively low. A lot of cards have been issued mainly through Aadhaar, but again, utilization, it suggests utilization might be a little bit low. A lot of hospitals have been empaneled, which is good. There was a slow start, but a massive increase in the last year and a half. A large percentage of these are private. Claims, typically, most claims have still gone to private hospitals and not public hospitals, which is good. That's the whole point of PMJ. We already had access to public hospitals. Now you're going to get to private hospitals. A large percentage of claims are, in terms of rupees, are by tertiary care hospitals, even though the average claim is still well below 30,000 rupees, which is the RSBY level. There are some implementation challenges that are still plaguing PMJ. The data, SAC 2011 is still is a little out of date. It was still being used as of at the start of this should say actually even 2020, and that's a concern. We need a better data infrastructure if we really want to effectively roll out this program. A very important issue is there's a very low package rate that discourages empanelment by hospitals. Also, the costs don't adjust for the cost of production by different hospitals. So we need different rates that are for city hospitals than rural hospitals, a kind of a cost of production assessment. There's a little bit of this where metro areas, aspirational districts, and teaching hospitals, some accredited hospitals will get a 10 to 15% additional payment on top of the base rate. But that's a very crude adjustment. We would like to see something more like an adjustment you see at US Medicare, where there's local cost of living or cost of production updates. There's also concerns about fraud. There's examples that were investigated in Rajasthan. This is one of the challenges to having outpatient coverage is the propensity to have fraud. I think we need to do a little bit more on this topic. So let me tell you some, I think, non-challenges, but issues to keep an eye on. One is politics. Very interesting about PMJ is that it's brought back and starts, unlike RSBY, which started in Ministry of Labor, this one starts in Ministry of Health. RSBY ultimately moved to Ministry of Health, but PMJ learned from its experiences and separated out administration to a separate agency, the NHA, and in part because I think that there's a different culture in Ministry of Health. There's a focus on supply side, not demand side. So if you want to protect the demand side, it was helpful to have it at a separate agency. I think that was a good move, but something to keep track of. Financing, it's again still pretty low. I don't know if that is really a constraint right now because utilization is low, but our hope is that you can increase utilization and then you're really going to have to face the actual budget allocations that you see. Okay, let me stop there and hand it over to Radhika. I'm looking forward to her comments.
Thanks, Anup. Let me just try to share my screen. Let's see. So can you see that okay? Okay, great. Thanks. Thanks for inviting me to this.
You could give it to full screen.
What do you see the presenters?
Yeah, we see the slides, but you can just take it to presentation mode.
Oh, it is in presentation mode. Sorry, hang on.
Do a slideshow.
Yeah. Let me try that. Try sharing my screen. I've run into this in the past.
Good.
Do you see that okay now?
Yeah.
Okay, great. Great. Thank you so much for inviting me here. It's been an extremely interesting conference already. And so let me just start right away with, I'm still having problems with my, okay. So it was a real pleasure to read this paper, and I've been in touch with Anup over the past few years about this study that they've been doing in Karnataka. And just to give you a little bit of the background into which where this study sort of fits in, Anup sort of touched on this a little bit himself, but broadly, the evidence on health insurance in lower income countries has been quite depressing. So enrollment has been typically low and has been found to be sensitive to price as well as administrative hurdles. And impacts have been extremely mixed. So there have been some increases in healthcare utilization, but modest or no decreases in out-of-pocket spending in many contexts, or else the effects are very mixed, and very muted effects on health outcomes. And importantly, just as Anup sort of mentioned, government health insurance has been scaled up rapidly over the last 10 years in India, and yet there's been very limited evidence of its causal effects in the Indian context, in part because our RSBY was rolled out across the entire country. And so what's really nice about this paper is that it's really the first RCT, or really sort of careful causal evaluation of health insurance access in the Indian context. It also tests, very policy relevant arms with the sort of looking at the cost effectiveness of different levels of subsidy for enrollment, including free provision, which is basically what's happening under PMJ now. It's also conducted at extremely large scale and measures a wide range of health outcomes. And this is something that has been much harder to pin down in the Indian context. And lastly, the sort of from a researcher's perspective, the measurement of spillovers is sort of an important contribution to how we should think about studying insurance. It's also an important contribution for policy because it suggests that we can maybe sort of leverage some of these spillover effects to increase take up of insurance. So let me get right into looking at the effects on enrollment and pricing. So the first really striking finding, I think, in this study is that enrollment is high, even when households have to pay for insurance. It's about 60%. And to put this in context, in a recent evaluation of health insurance in Indonesia, even free insurance plus enrollment assistance only led to about a 30% enrollment rate, right? Now, of course, when this enrollment rate increases when you make it free, but as the authors point out, making it free, given that even without free care, you have 60% enrollment, essentially making it free means that you're subsidizing a whole lot of inframarginal households that were willing to pay, would have bought insurance anyway. And then as I sort of mentioned, for comparison, enrollment in the main RSBY program in the same areas is about 40 to 60%. So there's this question about why is enrollment so much higher in the study? And I won't get into this in detail because he actually covered it, but there's one possibility is this fact that something about the fact that the research team went to the household and then escorted them to the enrollment sort of location might have increased take up, whether it's maybe the households now trust the product more, or maybe there's some sort of reminder effect of house because someone came and came to your house, or it could be a whole range of mechanisms behind it. And the paper doesn't disentangle this, but this is consistent with a lot of research showing that technology adoption as well as take up of social services is quite sensitive to some of these things, and some of these aspects of the program, and yet it's systematically underestimated by social policy in India. It also sort of suggests that, to some extent, that demand may be there if you can kind of ensure that the process of enrolling and taking up the program is not so hard. However, one implication that Anup mentioned is that you get most of the enrollment without any subsidy. And however, before doing away with subsidies, one factor to consider is longer-term re-enrollment. So in the study, utilization drops off over time, possibly because people didn't have good experiences. But this doesn't affect enrollment in the study because the government decided on auto-enrollment. Now, insurance is a credence good, and especially if insurance programs have teething problems and aren't super well implemented early on, we may actually, lose people, households over time if we require them to pay and re-enroll. And this may be why several other programs, including the one in Rajasthan, have sort of, decided to make enrollment automatic and renewal automatic. So anyway, that's one thing to consider. The other thing to think about is that even the arm that had no explicit subsidy is likely to be still, involve a substantial subsidy. What do I mean by that? So the premium in this program is about $10. And in the study, they find that at baseline, household health spending is about, medical spending is about $2,000, about $450 of which is inpatient care. It's hard to know what part of this would have been covered, eligible for insurance care. But it seems, we know from other studies and other experiences with health insurance in India that premiums were, especially early on, were likely too low, and that and they've been increasing in programs across the country substantially in some cases. So in Rajasthan, I think it went from about 450 rupees to 1,200 rupees in the last year. And this is likely to increase even further as people sort of learn about the program and actually start using it. Right. And so the point about this is just that as we think about the, sort of how this extrapolates to other programs in India, if premiums increase, unsubsidized take up at these higher premiums may be lower. And so we need to sort of keep testing what happens to demand at various price points. In any case, I think the sort of, especially when health insurance is government financed, what eventually matters is not simply the sort of take up enrollment at various price points, but what enrollment actually buys. And so sort of that takes me to the next set of results. So the study finds that there's increased use of RSBY to pay for treatment, but that this decreases over time. And as Anoop pointed out, there's no change in hospitalization or outpatient surgery. And this maybe, Anoop, maybe you can come back and discuss this a little bit because I wasn't sure. I thought in your slides, in slides that you had shared separately, there was some results showing that there was no effect on out-of-pocket expenses, some decreases in debt, but this wasn't in the paper. So maybe I got that wrong. But and then lastly, that there was no modest or no change in health outcomes. So I mean, this is a real puzzle. So if there is an increase in utilization, why is there no major effect on the outcomes that we care about? And there may be lots of reasons to unpack here, but let me just show you some results on some of the insurance research that I've done in Rajasthan that may help explain some of this. Okay, so in Rajasthan, I study a state government insurance program that's very similar in design to the one in Karnataka as well as to PMJ, except that it has free and automatic enrollment. And I got access to insurance claims data and sampled insurance claims and conducted phone surveys with patients about 2 weeks after a claim had been filed in their name. And so what's sort of powerful about this is that we're talking about patients who we know they're eligible, we know they went to an impaneled hospital, and we know that the hospital was reimbursed for the claim that, for the service that the patient received. Even nevertheless, there are some, the key sort of findings from that body of research, some of which is mine and some of which is joint with Pascaline Duprat, is that one, awareness is extremely low. So even 2 weeks after a patient has a claim filed in their name, 50% don't know that care under this insurance program is supposed to be free. And something like 5% were able to correctly identify eligible illnesses under insurance. Secondly, and again, keep in mind, these are people who have actually just recently used insurance. Secondly, I find that hospitals charge patients for care that is supposed to be free. And so maybe this explains why awareness is low, because essentially, even after people have used insurance, 40% of patients had to pay. And the amounts that they had to pay were substantial. They were about a 35% markup over the reimbursement rate that the government gave the hospital. So then a third thing, what we tried to do was see, okay, well, maybe awareness is a binding constraint. And so we tested the effectiveness of providing phone-based information to patients. And what we find is that, this was very effective at increasing patient awareness of what they were entitled to under insurance. And this was a very cheap, light touch phone-based intervention that could be scaled up. However, this didn't help patients hold hospitals accountable and sort of reduce the fact that they were paying out of pocket to hospitals. And this is in part because in the context of, critical life-saving hospital care, patients have very limited bargaining power and may not be in a position to demand that the hospital reduce charges. The next thing I look at is I study a policy reform that revised hospital reimbursement rates, right? The amount that the government pays the hospital for providing given services. And what I find is for every 100 rupee increase in the reimbursement rate that the government pays hospitals, there's a 50 rupee decrease in what the hospital charges patients out of pocket for that service. Okay, so what that suggests to some extent is that these reimbursement rates are a problem, and that they may be that hospitals are partly charging patients cash because the reimbursement rates are too low. When the government increases the reimbursement rate, hospitals can charge patients a little bit less. However, only about 50% of the increased reimbursement is passed through to patients in the form of lower out-of-pocket charges, right? And the rest is essentially captured by hospitals as profit. And this capture is particularly high in less competitive areas. And so this, kind of, again, sort of, I don't want to get too much into the details of this, but it sort of suggests that there's an important role for hospital oversight, because without oversight, hospitals are essentially capturing a substantial part of the government subsidy instead of passing it on to patients. And then lastly, I also find evidence of coding fraud by hospitals, which increases government spending, as well as over-provision of unnecessary care. And so the implications of this, going back to what these insurance programs are doing for household out-of-pocket expenses, I think a lot of research has sort of studied on focused on the demand side, but provider behavior, basically what we sort of show from Rajasthan is that provider behavior can undermine the effects of insurance on out-of-pocket expenses. And if people are continuing to have to pay for care, this could also to some extent explain why utilization of the program is low or / why it decreases over time. The second implication of those findings is that low awareness is a problem, and this is consistent with what Anoop's team finds in Karnataka, that awareness of insurance seems to be an issue. However, I think it's important to understand that in the context of hospital insurance, hospital care, addressing patient information alone may be insufficient, that patients do have limited bargaining power, and that you really are going to need sort of top-down monitoring of hospitals, attention to reimbursement rates, understanding sort of provider behavior in order to ensure that these programs are functioning more effectively. And the last really striking finding of the paper is this, that the effects on health outcomes are unclear. I really appreciated the fact that they point out the issue of power. I think that's something that other studies have sort of struggled with and aren't as upfront about. But I think the sort of broader takeaway from this is that to the extent that studies have been able to look at the effects of insurance on health outcomes, they've required large-scale administrative data. It's very, very difficult to do this through survey-based studies. You just need, extremely large sample sizes, and the effects of on health outcomes may also be somewhat subtle. Let me just move on because I suspect I'm running out of time. I think the two sort of big implications, one of this paper and what we can think and learn about health insurance more generally, one is that, implementation is really first order in lower income countries to increase effective coverage. There's a lot of focus on adverse selection and moral hazard in sort of richer countries in health insurance. And I think that, at this stage, when there's not very much take up of insurance, moral hazard is not really much of a problem. And I think what this paper shows is that demand may be there, and so you don't want to focus just on subsidy, but also things like enrollment, utilization, trust, quality, etc. that could affect take up as well as the cost effectiveness of insurance. There's really this sort of big question that all of us working on health insurance need to think about is that if insurance is not particularly affecting out-of-pocket expenses and not particularly affecting health outcomes, then what exactly is high take-up of insurance buying? In addition to all of that, I think what sort of I would make a plug for is that while it is true that the demand side is important for thinking about the cost effectiveness of the different levels of subsidy and things like that, I think the supply side of insurance is understudied and provider behavior, and that these aspects are going to be extremely important for the sort of financial outlays on health insurance as well as the cost effectiveness of programs, right? That something that sort of gets forgotten is that essentially these health insurance programs in India are sort of a pivot away from direct provision of healthcare through the government system to outsourcing to the private sector. Outsourcing healthcare delivery to the private sector. When you work with the private sector, you really need to understand private sector incentives. You need to think about pricing, or in other words, reimbursement rates. And these things are going to importantly affect the spending on the program. Provider behavior is also going to affect things like care quality, treatment decisions, and that these things may affect health outcomes. So just a general plug for studying the supply side of health insurance a little bit more. Thank you.
Karthik, you are on mute. Karthik, you are on mute.
Sorry. After all these years of Zoom, it still happens. So thanks Anup, and thanks Radhika. I think we got 2 for the price of 1. So it was great to see that summary of those results in Rajasthan. So I think there's questions before, and I'll just, as chair, just put one question in there. I know this was not the subject of either of your studies, but given you've done so much work on health insurance in India, the one thing I'm very curious about is, what does the empanelment process do in terms of providing information to the market with regard to the quality of these providers? So even if so we're focusing on insurance, which is just providing access to the poor, but these are also markets with an enormous amount of asymmetry of information, and since 70% of people are paying out of pocket and they have very little good quality information on the quality of these private providers, right? I mean, does the empanelment process, are there ways to look at that at time trends, and does the empanelment process do something about market share and incentivizing the greater market share of higher quality providers? So that was just my background question to either of you. And then, so maybe, I don't know, Anup, do you want to come in for like a few minutes responding to Radhika's comments, and then I'll open it up to the floor?
Yeah, that's great. So let me quickly talk about empanelment, and then I want to talk about Radhika's fantastic comments. And she really completes the picture on the paper that I presented. So that's important. So, but on empanelment, yes, there is some procedural requirement to become empaneled that does send some quality signal, but I don't think it's a fantastic quality signal. And one of the reasons is a lot of hospitals that are high quality that can charge a higher price won't be empaneled, and they're grouped with the people that are not empaneled. And so you don't know if it's a non-empaneled hospital is actually better or worse. I think what's really critical about this is the package rates. The package rates are fine for rural areas. You're going to get lots of hospitals that want to enroll to be able to get this customer base. But in urban areas, the higher price, perhaps higher quality hospitals don't want to enroll. And you see a lot. One of my graduate students, Sarojini Rao, looked into this. A lot of hospitals under RSBY that were empaneled, when you look at their utilization, it was 0. Suggests that a lot of people keep it as an option to get patients when you otherwise can't, and that's typically in urban areas. So I really think the panel rates are what we need to focus on, and just get a little bit more savvy about that. In addition, both the US and India need to do more to measure quality of care and incentivize payments based on quality. That, I think, is also an important challenge that PMJ ought to take on. It should do it early, not late like the United States is trying to do now. Okay, turning to Radhika's comments, I think the most important thing that Radhika said concerns health insurance utilization versus health care utilization and the impact of out-of-pocket care. And she actually solves that puzzle. So let me explain the puzzle. The puzzle is, our study finds that utilization of insurance rose, utilization of care didn't, suggesting mainly a financial benefit, but we see no changes in out-of-pocket. I didn't present that result, but I've shown it to Radhika. Radhika sees it. We don't measure statistically significant effects on out-of-pocket. Now, how do you reconcile that? Well, as it turns out, Radhika's study in Rajasthan reconciles this, because what it says is that because the package rates are low, hospitals charge an additional amount on top of that. So even if RSBY caused people to start using insurance more, meaning going to private care more, it could be their out-of-pocket didn't fall, because while they used RSBY payment, they also had to pay a little bit out of pocket to top off. Okay, and so I think what we'd really love to do is an accounting exercise, if we were able to get PMJ data, to see if in fact we observe this, and then if that could explain the out-of-pocket care. Now, what do you do about it is a different question. On the one hand, you want to say, hey, we should not allow hospitals to charge additional amounts. That's illegal. But on the other hand, the reason they're charging additional amounts is because the package rates are really low. And Radhika also has results, which are very interesting, with Pascaline Dupas, that shows that the amount of extra charge really is getting you, and Radhika, please correct me if I'm wrong, really gets you up to the cost of care, the market price. They don't seem to be charging necessarily more than that, suggesting it really is kind of getting back to a market price. I think more work needs to be done on that, but I'm very glad she brought that up. In terms of other things, I just want to point out two smaller items. Radhika pointed out that perhaps people were not utilizing care later on because they had early poor outcomes, meaning they tried to utilize RSBY at 18 months, failed, and so they didn't utilize it later. We checked into this to see if households were less likely to use care at 3.5 years because when they had an example of failed use, and we found no strong correlation there. So I'm not sure early failure is the reason. We still have that puzzle. A second thing that she stressed, which is important, auto enrollment is great for getting your uptake high. And I think that's really good. I'm glad PMJ includes this, but that doesn't fully solve the problem. And the reason is the following. Within our study, households that actually had to pay for insurance actually were less likely to be unable to use that insurance, to have failed use, meaning it was either somehow causing people to, when you pay for it, either causes you to value a little bit more, or it screens in people with greater value, which is a proxy for whether you know about insurance. Auto enrollment is going to go in the opposite direction. It might enroll a lot of people that have really low utilization because they just don't value it that much, or they don't value it that much. So I think that's a mix. Auto enrollment is great, but I think you really do need some level of education that pumps up demand if we want to see people utilizing this. Let me pause there because I think the rest of Radhika's comments are just great additions to the study that I presented and stand on their own.
Perfect. Thanks. In fact, Anup, if I can just follow up with a 30-second question to reconcile. So is what you're saying then, the utilization of insurance goes up, the of healthcare does not, the out-of-pocket doesn't change, but the billing changes. So then there must be a missing piece of the puzzle, that is the insurance causing people to use more expensive providers? Because you said there's no change in the utilization, but I didn't see you mention then that is there a gradient of kind of the cost of what they're using?
Yeah. So what's really interesting about this is this gets back at healthcare outcomes. Maybe what's going on is people go to private facilities rather than public ones. They're spending a little bit more, but they're not getting a lot from it because healthcare outcomes. This goes back to, I think, Radhika's other point, which is which I also stressed, which is we are finding that healthcare outcomes did not significantly increase from a statistical perspective, but they nominally do increase about 10% of the standard deviation. Okay, so there could be some health effect going to the private sector. The other thing that I think that is important to remember is think about overall supply constraints in India. Public healthcare supply only provides about 25% of care. And if you really think that supply can't keep up with demand over the long run, then what you do want to do is facilitate private demand, payments to private facilities. And I think that if we look over a 10 or 20-year horizon, the strategy we should take for health insurance, and here I'm going more out on a limb, is to subsidize health insurance and provide public health insurance in order to provide investment for private facilities to expand. This is a strategy that actually the United States provided after World War II. The United States provided low-cost loans to private facilities to expand so that they could keep up with demand created by, among other things, Medicare and Medicaid in the United States. I think India needs to think about the exact same thing. Public supply, I don't think, is going to cut it. There are separate studies that suggest that it's not that public supply solves the problems associated with private supply. Public supply has its own issues in terms of quality and in terms of actually providing care without cost. So that's what I think. I think health insurance is a strategy to facilitate the transition to a private healthcare sector in India.
Got it. Thanks, Anup. Let me bring in Dr. Subramaniam. I think he had a couple of questions in the chat box.
Yeah, thanks a lot, Karthik. Anup, I have a couple of, one which relates directly to your paper and essentially trying to square up what you are presenting vis-a-vis the careful analysis that we did using administrative data from the NHS. And the NFHS 4 and 5, looking at the health outcomes. I'll send the link, and so that those of you who've not seen it can actually take a careful look at it. Firstly, when I look at the utilization, So, in itself, if you look at the PMJY, primarily it is used for high frequency, low cost, of things like dialysis. And when we look at it in the time series, dialysis versus general medicine, pre-authorizations, what you see is a V-shaped, decline and then a recovery during COVID for general medicine, not for dialysis. And then similarly, if you separate it by costly procedures versus less costly, cutting it at 2,500 based on pre-authorization amounts against, based on NHS data, again, you see this basically that costly treatments actually nosedive, while less costly treatments actually went up during the COVID period. So and this is, do remember, compared to your RCT, which is basically maybe a couple of districts, this is all India data. Point number one. Second point is, on the health outcomes itself. And here, again, this is not something which is not just showing correlations, we're showing difference in difference using West Bengal vis-a-vis neighboring states. That's the first setting. Second setting is all of India, those that implemented, PMJY versus those that did not. And there actually, again, significant using, remember, this is not administrative data. This is survey data, the National Family Health Survey, NFHS 4 and 5. So basically provides a before and after sample here. And, again, we find actually important effects on health outcomes. So, I would be very careful in basically, especially when you are talking about policy implications, etc. I would be, I think, very careful on, in those, because it seems very speculative to me, especially given the very important and I think useful comment that the discussant made, Radhika, on the lack of power in survey settings. So I think given that, therefore, you will have to, and hopefully the referee pushes you as well, to square up your evidence with basically what we have provided for PMJY in the economic survey chapter. Second observation I want to make is about overall, the healthcare budget itself. And I think here, between curative versus preventive, India over the last few years has put a lot more focus on the, on the preventive side. For instance, the Swachh Bharat Yojana, the sanitation program, the Jals, Nal Se Jal, all of these are part of the preventive. And I think this is something that health economists, therefore, have to start looking at, possibly the fungibility between preventive spend and curative spend. And, based on that, then basically, should we be adding up these rupees or dollars, or should we just be, when we talk about healthcare budgets, just keep focusing only on the curative part, or start thinking about how to include the preventive items as well? And particularly because in a country like India, when you have, if you take the Swachh Bharat Abhiyan or the Nal Se Jal, they have actually significant impact on communicable diseases. And again, here as well, the evidence we've provided in the 2018-19 economic survey on the Swachh Bharat Abhiyan actually shows that there has been tangible impact on communicable diseases. So I think that's the second point in terms of overall macro. When you start looking at preventive versus curative, how do you think about actually adding up these dollars or rupees? So these are two broad observations. But I think my first point is actually, again, something that I will really emphasize. I mean, I understand, we'll be getting into territories about RCTs, the external validity, etc. And I think there is a religion out there. But we have to be, careful given the all India level evidence that we've provided. Thanks.
Yeah, so thank you. Those are great, and I do encourage you to read the report by Dr. Simonian. It is a fantastic and thorough report. As he stresses, there are two big advantages of his study. It's about PMJ rather than RSBY, which is the current program, and number two, it's all India, so it's national as opposed to just Karnataka. That said, I want to stress a few things. Kind of weighing the two studies. One thing about the new study is that it's looking at big changes in health from, say, data from 2014, or so on health to say 2019, 2020. So there's a big gap. Some of that gap is covered by PMJ towards the end, but some of it's also covered by RSBY, which was winding down a little bit. A second issue that I always think is very important is to think, are the changes only the result of PMJ? The states that seem to expand PMJ are not randomly selected. They're actually probably more progressive states when it comes to making healthcare investments. So we don't know if the investments are due to PMJ or the other thing that Dr. Subramanian points out, which is expansion in preventative care or just better facilities. So I don't know if it's a pure insurance effect. The other thing that I want to point out is a lot of the PMJ benefits are from these low-cost frequent treatments, yet the big benefits come from mortality effects. And it's very hard to imagine that these low-cost expenditures are the ones that are driving mortality effects. I mean, in some sense, the work that like Neeraj Sood did on Arogeshu Vajpayee, which is big cost investments, those seem more likely to, although I think even that study has implausibly large reductions in mortality. A second comment that Dr. Subramanian made, which is very important, is budgets and a large amount being spent on preventative. I think that's a great idea. I mean, I think COVID underscored the importance of doing things like vaccines and the central role that the government plays in that, and that should continue. So I would only humbly suggest that we not always think about health insurance as trading off with preventative care. That is to say, subsidies for therapeutics trading off with preventative care. India is spending less than other countries as a percentage of GDP on care at the same level of per capita income. So you can imagine that the government makes a decision to expand public health insurance without sacrificing any preventative. In fact, if it were up to me, I would say COVID tells you that you ought to build out an adult vaccination distribution system, and that'll require more investment on preventative as well.
Karthik, if you would quickly allow me just 30 seconds.
Yeah, please. And then I'll bring back Radhika, and then I think, Arvind, you want me to stay on time. So almost at time, but I think we can take 3 minutes more. Go ahead.
Yeah, quickly, Anup, I think, some of the things that you mentioned about more progressive versus less progressive, etc. I mean, these are mostly time invariant stuff, actually, which the fixed effects pick up. So, I think it's far more careful than just that. Thanks.
Radhika?
Thanks. I just wanted to go back to the, your earlier point about just thinking about what this is all doing for quality. I think from having, I don't have evidence on this, but based on field visits, I think empanelment does, and in insurance, does sort of cut out the very bottom of, there's a sort of really a continuum in India of health facilities and what gets called a hospital and what quality it is. And I think it's very obvious when you visit these places that, not a lot of them may not be great facilities, but the very worst of them are not impaneled. That said, why doesn't, I think, and I will say, even though I said, I appreciate that Anup brought up power, but I think, this paper is valuable because I don't think power alone explains the low outcomes. I think he's right that part of, especially early on at this stage when people don't know that much about these insurance programs, I don't think insurance is particularly increasing use amongst people who wouldn't already have got hospital care, and it's probably not my guess, and it's probably not super changing where people are going. So essentially, it's it's essentially subsidizing care that people would have got anyway. That's my guess, but that in part because changing your behavior in major ways right now is extremely risky financially, right? Like you don't know whether when you get to go to a hospital, if you wouldn't have got care otherwise, you don't know whether by the time you get to the hospital and start getting care, whether you're going to be covered or not. Like, I just think it's too risky for people to majorly change their healthcare decisions based on insurance as it is implemented now. That said, as and people don't know which facilities covered, et cetera. But as I think the combination of empanelment, cutting out the worst facilities, and if implementation can strengthen over time and people sort of learn how the program works, which facilities are covered, this kind of thing, you might see shifts that would actually lead to changes in health outcomes. So,
and I think just before wrapping up, I wanted to respond offer my take on an issue that came up in the chat comments a lot. I think, there was somebody, and I think in the audience, not in the panel, definitely concerned about the very crude basis of targeting. And, I think we all agree, but, I think these results put together suggest the importance of eventually having a finer targeting kind of database that allows you to have a sliding scale of subsidies so that it's not like zero or nothing. And given that people do seem to be willing to pay when you manage to go, because Anup's concerned that when you do this way, about 60% of the spending is going to inframarginal households, I think is obviously really important from public finance perspective. But conversely, you also want to reduce the negative incentive of accumulating these assets. If from a targeting perspective, you're going to lose a whole bunch of benefits. And so the importance from a larger, and if I can take a 30-second detour, people think about the disincentives of a welfare state in terms of raising the taxes on the rich. But the data suggests that the bigger disincentives of the welfare state come from the fact that when you target, if I need to phase out the benefits as you're getting richer, that's a very high marginal tax rate, right? I mean, for the poor, as they're working their way up the income ladder. So I think kind of, the broader point that goes well beyond health insurance here is them thinking about smoother, continuous targeting regimes that allow you to offer a sliding scale of subsidies so that you're not kind of paying so much on inframarginal households, but also kind of maximizing coverage. So, thanks so much for that session and for both the papers. And thank you, Arvind, for putting this together and giving me the opportunity to chair it. So back to you.
Thank you. Thank you all. Just a quick comment on Karthik, what you said at the end, sliding scales are fantastic, but they also empower the bureaucrats a little too much. So practical issue there is a different one. So be careful of sliding scales.
Good point.
Yeah, it would require automated data. Exactly.
So this has been a fantastic beginning for the conference. Thank you all for joining. And we will begin again at 9 a.m. Eastern Time and 6:30 p.m. Indian Standard Time tomorrow, and also on Saturday. We start with a fantastic panel on digital platforms of India. So the digital economy of India. Mary Jaino, our ex-dean of CIPA, will be moderating, and that should be really fantastic beginning. And then we have paper. I think Nandini is doing the paper tomorrow, and we have a conversation with NK Singh afterwards. So again, 3 sessions tomorrow. See you all. I hope tomorrow at 9 a.m. And bye-bye.
Thanks.